later on today to join Bayern Munich. A 4-year deal reportedly worth, Tom, $110 million.
You tell me, John, you're expert on this. How does this team go on? I mean, I don't even know what the American equivalent to this would be. This is a way bigger deal than Aaron Rodgers leaving the Green Bay Packers.
Forget Harry Kane. Forget all the players involved in this, with the exception of one man, Daniel Levy. To do this going into opening weekend for the Premier League on the eve is absolutely shocking. To see that happen, to lose your best player with no time, very little time left in the transfer window ahead of a new season, to replace him and think about rebuilding the team. Because this isn't a man who just scores goals, Tom. He's a guy who drops back, and you've seen there, you've been to White Hart Lane and witnessed the game. Drops back. There's a lot of work in the build-up play.
Yeah.
As they make attacks.
Well, my amateur take here is this guy's what you call a striker, which is the guy up front scoring the goals. But the magic that I saw that you don't see on TV was how he would help the middle of the field begin to create plays forward.
So, Tom, let's think Pete Brady, Patriots, right?
Tom Brady.
Except Patriots won things and Tottenham don't, but let's put that to one side. Imagine this happening right before the start of a new season and not knowing who your quarterback is. That's ridiculous.
I think what's important here, Lisa, is we need team coverage here. We're going to be in London here in the next coming weeks, and I just do think a remote is in order.
A remote to London or a remote to
Arsenal
Germany?
Or to us, I'll let John see.
Did you see the club he led with, though? He said Arsenal.
Really? You're going directly to their competitors? Seriously? By the way, we don't even know if Harry Kane's going to go over to Bayern or whatever.
He's a medical.
Yeah, well, I mean, it's sort of like maybe there's still negotiations.
There was some odd story that he was on his way to the airport, and then he had to turn around because he hadn't been given clearance. I saw some of the reports coming out of the UK, just absolutely bizarre. It looks like, based on reports, this is like this close to happening. So we'll see. Watch this space.
We're going to move forward here with the advent of Premier League football, and truly a joy to have John Farrow driving our coverage on Premier League and on F1. Is the F1, they're often like till September 1 or something, right?
Yeah.
You know, we're going to wait on Monza and all that. John Farrow from Monza.
Monza in early September.
You can see it right now.
It's one to watch.
Of course, what you want to understand is that Man City plays Burnley this weekend. In the last 8 matches, thank you, BBC, for informing me. Here's a partial score. Man City 26, Burnley 1, so we had to go out and get a token Man City fan to start off the season. And John, for you to bring in Abigail Watt at Aberdeen, I just think is brilliant, because she more than anyone we know, she bleeds the light blue of Man City.
We've got to be really careful here, Tom. There is a difference between a main road Manchester City fan and an Etihad Manchester City fan. A main road Manchester City fan is a fan of the club when they didn't have money. That was the old stadium. They'd watch them get relegated, come back up. Really difficult. An Etihad Manchester City fan is the kind of fan that supports the team that's winning because they've got a ton of money and they're all the best players. Abigail Watt is a main road Man City fan, research economist at Aberdeen. Abigail, wonderful to catch up with you. I actually wanted to start in the UK, if that's okay. The data out of GDP, pretty decent relative to expectations. We were over at the IMF World Bank meetings back in spring. They were talking down the UK hard. Can you tell us how well that economy is performing at the moment, just in the aggregate numbers, and then we can turn to what's happening beneath the surface?
Yeah, so as you'll have seen this morning, the UK growth numbers came out a little bit stronger than expected. We saw a 0.2 Q-on-Q increase in activity in the second quarter. If you dig into the detail of that, one of the key things that we saw was a return to work after the kind of holiday that we'd seen in May. So the industrial production side was pretty strong in the June growth data. That said, services were also a little stronger than expected. So, you are continuing to see, I guess, consumers being, I guess, more resilient than perhaps even we'd expected in the UK.
Abigail, there's just a lot of talk about this here, and a great fear, I think, over time is the concentration of prosperity in London versus the rest of the United Kingdom. As you look at finance and investment, for Aberdeen, is that an advantage or a hindrance, not only in the United Kingdom, but in other countries?
Yeah, I mean, I think you have to think carefully about your investor base. I think it does help, I guess, having that concentration in certain areas is useful for us as a firm. I guess, operationally and kind of finding our clients. But I think economically, the kind of prosperity of the whole country matters and is important for the, I guess, longevity and the sustainability of growth in a number of economies. So I guess it depends whether you're thinking from a macro perspective or a micro perspective on that issue.
Just broadly, people are talking about this soft landing on a global basis, albeit much more in the U.S. than in the U.K., although growth coming in stronger, even amid some of the inflation. When you take a look at the forward drivers of inflation, and I think increasingly about oil as demand reaches new record highs, food as the prices keep ticking up, are you in the camp that we could see a reacceleration that people are shrugging off and really not counting on?
Yeah, I think we're looking really closely in the US in particular. You know, we've been very focused on kind of core services inflation and core services ex shelter. This is where the Fed have been kind of focusing their attention to. And that was one of the things that I kind of noted from yesterday's inflation data. Although the aggregate kind of top line numbers came out in line with expectations, one of the things that we saw was some of the core services, in particular recreation services and education services, coming out kind of much stronger than they had in June in terms of the month-on-month prints. And so there's definitely pockets within that kind of services sector which we're concerned about. I think the other element you've kind of mentioned there is around kind of the headline pressures, thinking about energy prices and food prices. On the kind of energy price side, we've seen this kind of summer boom almost in kind of commodities, in kind of oil prices, and that's likely related to kind of increased travel. We're kind of, I guess, we're less of the view that can be kind of maintained. I guess where our expectation is that the economy will begin to slow and therefore you'll see demand kind of slipping off again. The other thing that I think we've seen this week, which is interesting, is more news around kind of natural gas prices. Natural gas reserves have been kind of built up in the European area in particular, given some of the kind of effects of the Russian invasion of Ukraine last year. But we did see kind of news of strikes in Australia. And the kind of pass and feed through effect of that through kind of natural gas markets. And you saw that happen quite quickly this week. We've since seen, I guess, some of those fears abating, but it does show that, you know, there are risks there to the upside still on inflation.
Abigail, with all of that in mind, let's finish on this. Where do you have more confidence that we've seen peak rates? The Fed, the Bank of England, the ECB? Where?
I think the Fed, likely. I think the inflation dynamics have maybe shifted slightly in the US relative to what we're seeing in the Euro area and the UK. In particular, I think in the wage dynamic, we've seen a little bit more progress on kind of softening wage pressures in the US relative to the UK and the Euro area. So I would say, I think if I was trying to say where I think peak rates are likely to have happened, I would say the Fed is most likely of those central banks.
Abigail, thank you. Come back soon. Abigail Watt of Aberdeen, thank you very much. Thank you. It's good to see you. TK, peak rates of the Fed potentially, the Bank of England, the ECB, seems to be the takeaway at the moment. They've got more work to do.
And the new overlay of this week and to contemplate into Q3 and Q4 is the idea of deflation. And there's some really interesting dynamics here. Somebody yesterday had the keyword residual there. And, you know, I worry about the deflation overlay and all of our certitude about where we're heading.
I am not worried, for the record, about airplane ticket deflation. I am okay with that.
I'm fully embracing
I'm fully embracing airplane ticket deflation.
One of those things in the CPI report where they tell you something's happening and I'm sitting there thinking,
don't believe it.
Is it really happening?
100%.
Is it really happening?
That was what everyone was thinking.
Vishy to the Patura of Morgan Stanley coming up.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, Our average restaurant now does about over $1 million per restaurant in digital sales.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
I've had the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Saw the rebound in home values after they came down, and that could create a rebound effect along with higher energy prices and some more supply chain problems, which is why the Fed is hesitant to declare victory. I think they're done on rate hikes, but I think the higher for longer narrative is now what they're going to be leaning into very hard.
She is just one of the best. It's Diane Swunk, chief economist over at KPMG. The conversation at the moment is pretty divided. I would say the consensus believes this might be the end for the Federal Reserve. Then there's a debate about when they start cutting, potentially early next year. There are also people out there who just believe inflation has the real risk here, the potential of re-accelerating. I would say Neil Dutta of RenMac is one of those who is questioning whether the Fed has done enough. The group over at Citi, Veronica Clark, Andrew Hollenhorst, two of those as well, raising the same question. Let's turn to the price section for you. On the S&P 500, futures slightly negative here. Lisa gave you the day ahead. PPI coming out a little bit later at 8:30 Eastern time, following CPI earlier on yesterday. Through the week, the attention very much on what's developing over in China, or rather on what's not developing, Tom. And what we haven't seen is the large-scale stimulus that maybe people were hoping for. Just hasn't happened yet. And the new loan data out of China, really, really weak. SocGen first out the gate of the notes that I saw on the south side, saying this just adds to the chances of easing out of the central bank.
And the first effort of Beijing is the allocation of debt, the visibility of debt, whether it's within the companies, the state-owned enterprises, or it's within the cities and that. And frankly, it's a Greek to me, John. I can barely keep up with what really this amounts to is domestic demand and the price change around that. If you have a slower China, do prices just slug down? That's the fear.
And does this become a problem for US markets? When do we wake up and have one of those mornings where you just see treasuries bid really hard, equities down, commodities struggling because there's a real concern about that economy? Lisa, we haven't seen that. Evergrande, do you remember when Evergrande got into trouble? There was concern, there was concern, there was concern, and then it happened, and nothing really happened in financial markets stateside. Are we having that same approach to another developer in China?
Country Garden Holdings, which was bigger than Evergrande.
Is it bigger? I didn't know that.
Yes, it is trading as a penny stock now on the Hong Kong exchange. It's been downgraded to CCC. People are saying it's going to default. It hasn't made its payment on its interest, but it has a 30-day grace period that it's still in.
That's what I don't understand.
Against its bondholders and paying back its, particularly the interest payments, the coupon payments to the people who hold their debt. But this raises a question. No one cares in the U.S. Why is that, given the fact that this is an even bigger developer? Have people written it off? And have we really divorced the U.S. economy that much from China?
It's really what I'm getting at, Lisa, and I think we're on the same page. There is a comfort to some degree with what's developing up over there. Not my view, based on what I'm seeing in the price section every single morning when you see these developments turn in, I would say, less positive directions week after week.
Well, I'm looking for China to open up, and they obviously opened up after COVID. I got a huge response yesterday to $39,000, two people business class to Shanghai. That worked out, and people said, you're nuts, and then somebody came back and said, oh, actually, you're right.
Do you know how many people said the same thing to me?
Yeah.
Tons. After you said it, they went and checked.
I know, I checked too. I didn't believe you. And then you were right, and I was kind of shocked. Not that you were right, but just that, you know.
No, it's all right. That's on the record, Lisa.
We're living in real time. Let's put it that way. What we're going to do is migrate to the airline business. And what's so important here is we all have, John has his flights. He looks at Italian islands I can't pronounce. Lisa has a host of flights where she has to sit in Atlanta at Hartsfield for 6 hours delayed.
Hey.
And I have 2 flights. I have a flight to Paris I look at just as a benchmark to Europe. And I just look, Lisa, conventionally at New York to LAX. And I look at Google, and they got the little red and the green and the yellow stripy thing about where's the value. In 1,700 business class right now, or 2,000 is what Google calculates, is actually pretty attractive. We're getting over to the green side. That's almost a legit price, a lower price of New York to LAX.
Legit price, and this means deflation, which is what we saw in yesterday's CPI print, and everybody said, no way, we're not buying it because it's not what we're seeing. George Ferguson covers the airline industry for Bloomberg Intelligence. George, how long can true deflation last in airplane tickets?
I mean, it's going to hurt profitability for sure. I think if the airlines could change it, they would, right? Because I think it's part of the competitive dynamic. Everybody's returned capacity to the marketplace, and I feel like it's the consumer starting to, run out of gas. I think we've said that for a while, though, so maybe they're not starting to run out of gas. They are running out of gas. Some of them are. Which is taking demand down, and business hasn't really returned, right? Not in full force. We're seeing it 65 to 75% of what it was pre-pandemic, and I think that's the dynamic here behind airfares coming down. I think it continues.
I want to push back a little bit because if you look at the CPI, it really is based on domestic fares. When you take a look at where people are going, it is international. That has been what's fueling the profitability. And those prices, if Tom Keene's gauge of flights to Shanghai or any indication, are not going down. So at what point are we seeing a distorted metric about deflation that's really focused on domestic markets that haven't yet picked back up, even as average prices continue to increase pretty dramatically?
Yeah, so I'm not going to disagree with you. We spent a bunch of time yesterday on correlations with CPI and airline fares, airline yields, and totally agree that domestic is a lot more correlated than the international markets. But what I will say is there is a small correlation. We are finding correlations higher after the pandemic, which is a long way of saying there's more consumer in that number right now. And so that consumer CPI is mirroring airline yields more. But I guess if I drop back and I just think logically about this, there's a lot of demand for international this year, especially Europe. China is its own issue. There's not all the capacity back in that marketplace yet. So those aren't real fares yet. There's real limitation there. But if we drop back and we think about it logically, look, we see a big snapback in Europe like we did domestically, Latin America, as we came out of the pandemic. Europe's been open about a year or so. We don't think this can persist into next year because we think the bounce back is this year. And in Europe, yes, you'd plan earlier. So I think there's probably a lot less tickets to sell. And that probably hangs in there for most of the year.
George Ferguson, you're expert on the actual planes and the engines and all that. I saw a wonderful Big Jet TV YouTube video yesterday of an Air Canada 747, which had been repurposed as a cargo jet. Is a lot of that going on, the efficiency of the George Ferguson world? Is everybody repurposing airplanes for the new Ferguson aviation era?
So I don't know if it's the Ferguson aviation era, but I like it. I would say that a lot of airplanes were repurposed into cargo during the pandemic because cargo was so hot. Air freight rates have come off very dramatically since then. I think you're going to see a lot less of that. Lufthansa, big operator in the logistics world, earnings, their 2Q earnings in logistics down 90+%.
Wow.
Yields have really, air freight rates have really come down. Again, they're getting back to normal. They're getting back to pre-pandemic levels, but that pandemic surge in air freight over, less of that going to happen, Tom.
Do you pay for a subscription, TK?
I pay. He's so good.
Do you pay for this?
Yes. The guy that does Big Jet TV, he'll give a shout out to Ferguson. Ferguson's so large. But the guy that does it is the son of a pilot. And his enthusiasm about it is what we knew as kids.
How much is a sub?
777.
How much is a sub? How much is a sub?
I don't know. Vet Bill's in charge of that. But it's great. The guy's flying around the world, DFW, Anchorage. He was in Anchorage a couple weeks ago doing a cargo thing.
Okay.
He goes all around the world.
I thought he was British.
He's British. Yeah, he's British. But his famous thing, he's at 27R at Heathrow, and he watches the planes take off, and they come in, and they'll be way off in the distance, and I can't tell what it is, and he'll go, triple.
Okay, can I ask you a real question? Did you even know about Big Jet TV until that one day that we were on air?
Clue.
Of course you did. Right. So just saying that.
I'm pretty sure I introduced you to Big Jet TV.
I think you did probably.
Yeah. George, thank you. George Ferguson of Bloomberg
Ferguson
Intelligence.
Didn't expect this.
This show's off the rails this week.
It's good. It's summer.
Is that what this is?
We'll become more responsible
summer
in September just for you.
After Labor Day weekend, we become more responsible.
Some of us don't go on 4-week vacations, John, where we have to go off the rails.
I'm running a tally. You've taken more time off this year than I have.
I'm staying out of this one because I probably would win this one.
You're becoming more Euro.
I am very sensitive.
More Euro by the day.
Euro by the day. Yes.
You like that, though? You think we've got it right over in Europe? I feel like you're coming to that side.
I have always been, and it's from my parents, embarrassed by the American work ethic, which we are as guilty of as anyone, of work. You go on vacation and you work while you're on vacation. I literally studied for the CFA exams on vacation.
I'm jaded. I grew up with academics. The summers for free form.
Like 3 months off.
Yeah, pretty much traveling.
Academics don't work.
You guys, John,
You're kind of not kidding.
Maria Tadeo.
Totally wrong.
What a dream.
Maria Tadeo does it so much better than we do.
Where is Maria?
She's on vacation.
Exactly. Of course she is. Emily Rowland of John Hancock Investment Management coming up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And the Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio. your global business authority.
It's hard to see where this recession is going to come from.
We're going to be in this 3 to 5% inflation environment for the next 3 to 5 years.
I do think that there's probably a little bit more disinflation in the pipeline.
I think it's appropriate for the Fed to take a pause here and see.
I'm so convinced that inflation is going to get down to 2% on its own, with or without any help from the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Is that 3?
Yes, that was the 3rd.
This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Plenty of feedback in the last 5 minutes when I said this show was off the rails this week. This lit up. Only this week, only this week, only this week. It's always off the rails.
Come on, I'm medicated. Harry's going to Germany. I'm medicated.
You're medicated. Is that what this is about?
Yeah.
Your equity market right now is negative 0.1% on the S&P 500. Again, we're talking about China. Some of the recent data out there, pretty difficult. It's a tough moment for that economy. The question we've all got, what can they do about it, Tom? What are they willing to do about it?
A lot of hand-wringing about what they're going to do, and the theme today for those overnight is a look of Beijing out to the cities, and the cities are not just the new Hong Kong and Beijing or Shanghai. It's a huge country out to Chengdu, to make a generalization of it, of devolving debt tension out to the cities, and that will be, I think, the storied point over weekend reading as well. John, I would dovetail it with currency dynamics, what we see with Euro Yen and Steve Englander earlier. And also, amid this disinflation, can I note that the real yield is right back up near that 1.80% level? We haven't talked about that yet.
So disinflation stateside, Tom, in China, the data so far, deflation, and fueling that conversation this morning, the team here at Bloomberg leading with this line: Chinese banks extending the smallest amount of monthly loans, Lisa, since 2009. That's just going to feed those fears a little bit more.
And is this an issue of banks not willing to lend, or people and companies not asking for loans? This is the real question. If you have an economy that's in stasis, that's basically atrophying in certain areas because of age differentials, because of consumers not spending, what do you do? Do you stimulate at a time where there's this debt overhang? And then the larger question, does it matter for the U.S. economy? To what degree are we not pricing that in?
Absolutely nailed there, the microeconomics of it. The media focuses on banks as what's Jamie Dimon doing, what's Brian Moynihan doing, and as you correctly state, the loan demand is absolutely critical from the public. The other way I'd look at this is disinflation towards deflation mathematics is just not studied because it doesn't exist, except the British have as a third rail an understanding of this before World War II. Their depression was totally different than ours and was a true outright deflationary moment. The British and their academics just totally gets this mathematics, where Americans were like, growth, 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 growth. It's all going to get fixed. Growth, growth, growth. We'll fix this. We need more growth, like what we heard from the president overnight.
Are they pushing on a string? Let's make this really, really simple.
Yeah, that's a cliche from the 30s.
I speak to a lot of people who know what they're talking about in China right now. There's a shock to confidence. What can they do about it? Coming out of the shutdown, we all thought China booming. That was the consensus view for 2023. China boom, US potential recession, the Fed cuts rates. Turn that story on its head for the year so far.
Yeah, well, I wondered, like, does Andrew Hollenhorst, Bill Dudley, does Mohammed El-Arian suggest that we need to worry about deflation? I think they would push back against that. They would say the system will solve that angst.
Let's turn to the price action. Got a great guest coming up who's going to talk about some of this. In the equity market, almost totally unchanged on the S&P 500. Talked lots about the bond market through the week. We had some issuance from the Treasury. I say some. I'm using that word loosely. Had a ton of issuance from the Treasury this week. 3-year went okay. 10-year was all right. 30-year was a bit of a struggle yesterday, so that fueled a move in the Treasury market. Yields up, Treasuries down. This morning, yields down by, let's call it a single basis point, Lisa, on a 10-year, 4.0958%.
Yesterday, we got the CPI report. Today, we get the chase for the U.S. PPI report. That comes out at 8:30 a.m. Do we see the same kind of disinflation that can give everyone this warm and fuzzy feeling of a soft landing? Or do we start to see it tick up and concerns, particularly about commodity prices, starting starting to reverse and inflect upward. 10 a.m. we get the University of Michigan Sentiment Survey. Interesting to see how much longer-term inflation expectations track the recent increase that we've seen in oil prices. And just there is this direct inverse correlation with oil prices and sentiment. And do we see that kind of play out today? And 12 noon, I really do feel like we need to keep an eye on what's going on in the agricultural space, just considering the increase that we've seen in wheat prices and this just general inflection up in food prices, corn, soybeans, cotton, and wheat. An hour later, we get the rig count from Baker Hughes. I don't know. I'm really interested in commodities.
We're doing rig counts all over again.
I mean, to me, the U.S. is record supply,
Yeah.
but demand is at a record, and we've got oil poised for its 7th straight weekly gain if the gains of today hold on. What does that do to this narrative of the disinflation of the good space if you get that bleed through kind of effect?
We could be pushing 13 million barrels a day in oil production in the United States by the end of the year, Tom. New forecast earlier this week is quite a number.
Yeah, Cardinal Roll, the math is there. Try not to predict the oil market. It's a good way to lose your job. Look at Jeff Curry. He's gone at Goldman Sachs.
Whoa,
but the answer is...
You have to correct that. He was not pushed out for getting the market.
Good morning, Jeff. Good morning, Dr. Curry, I should say.
Okay, carry on.
I'll carry on here as we hope. We wish Jeff Curry the best of luck. But the bottom line here, John, is you know what? Brent crudes are $90 a barrel.
You can't start rumors like that. You know that, right?
Who said it was a rumor?
What?
TK, you're in the penalty box. Jeff Curry departing Goldman Sachs, and not because he got a crude forecast wrong, TK. Emily Rowland joins now, co-chief investment strategist at John Hancock Investment Management. Emily, don't worry, we'll keep him in line. Let's talk about China. Emily, do we want stimulus out of China right now if you have a seat at the Federal Reserve?
Well, I don't know if it's working necessarily. You look at some of this loan growth data this morning, and it's simply not showing up. I think the China stimulus narrative is one that the markets have really loved and embraced, and we're getting a bit of a reality check on that. As it relates to commodity prices, all of this news of stimulus has certainly pushed them up, pushed inflation expectations higher, and that's become a big problem for the Fed here, who certainly has not yet claimed victory on inflation. So we're watching that really closely here, but a lot of mixed messages. And by the way, speaking of mixed messages, I understand trying to get to the weekend here, as you've said all morning long. If you watch the macro and you watch the fundamentals this week, the market action didn't really make a ton of sense. Of course, we had the Treasury auction that you talked about pushing yields higher, but at the same time, the economic data were pretty disappointing. You had softer inflation, you had initial claims picking up, you had dovish comments from the Fed. Meanwhile, the 10-year Treasury yield sort of right where we started, and European equities trading on another planet right now.
And Emily, within your note, you talk about whipsaw, and I think it's perfect. There's one big group whipsaw here over the last number of weeks, whatever anybody's belief. With that said, in the group whipsaw that we're in right now, how do you position out 1 year or 2 year in my depleted 201k?
Yeah, it's tough. So the macro signals right now are like a stoplight. They're going from red to green and back to red. And we look at the macro messages right now as more of a yellow. You want to maybe take your foot off the gas a little bit. You want to look both ways. You want to proceed with caution. So we're starting to see this big shift in sentiment. It's been pulled back a little bit over the last couple of weeks from fear to greed, and you're starting to see more cyclical, higher beta parts of the market outperforming. We would be mindful of taking too much risk in this environment. Again, we still want to be invested. We still like higher quality stocks. We think bonds can do more heavy lifting in a portfolio. But look, the leading economic indicators have been negative for 12 straight months. The yield curve has been inverted for 13 straight months. I mean, it's just become exhausting. But we need to stick to our premise here. We need to stick to our work that tells us that a recession is likely to unfold due to the lagged impact of Fed tightening, but it's becoming difficult to stay patient for sure.
I just want to pick up on what you said about European equities trading on another planet. What do you mean? Just the fact that they haven't sold off more aggressively in the face of China weakness?
Yeah, I think it's notable to look at the strength, particularly versus domestic equities as of late. Europe has certainly been more tied to China stimulus. You've seen that. You've seen a big momentum trade there, I think, as some short covering has resulted in a lot of gains in that market. And you're seeing, some major companies in Europe disappointing on the earnings front, some solvency issues there. Markets really seem to be very much enamored with Europe. They're very much enamored with this China story, and it just doesn't match up with the macroeconomic data. Look at the Citigroup Economic Surprise Index. It's surging in the United States right now, and it's about negative 100 in Europe, and yet those markets are outperforming. To us as macro investors, we want to continue to emphasize domestic equities because of the relative economic strength here.
That said, U.S. tech underperformed this week, I should say, not this year. This year they've outperformed tremendously, but how much is that going to be a real challenge to your thesis if it continues?
Yeah, we've definitely seen a pullback there, and of course, valuations were stretched, and we were expecting to potentially see, a bit of a profit taking there. And I still wonder if tech is the biggest issue that markets should be focused on. It's hard not to like quality in this type of a market, and of course, tech is your poster child there. I think over 3-5 years, we've seen the U.S. technology sector has produced of the best earnings globally. Of course, we want to diversify from some of that. Look at some of the ways the sectors that are starting to perk up a little bit here. Healthcare, one of our favorites. It's trading at a meaningful discount to the S&P 500. It's got the quality metrics that we love, great balance sheets, good return on equity, and it's more defensive. So I do think that the baton can be passed here in the back half of the year into next year to some of these more defensive sectors in order to create that balance away from the tech sector.
Emily, final question. Are you on the strong dollar train as well then?
Yeah, we have been. The way that we look at the dollar is where's the best relative economic growth and which central bankers globally are going to be continuing to tighten the most. And because of the relative strength we talked about here in the U.S., we think that's the U.S. Federal Reserve. We think the U.S. economy is doing the best. We also think if a recession unfolds, which is our base case, there should be a bid for U.S. dollars. I don't know that the dollar goes gangbusters like it did in the first few quarters of 2022, but I would say I would fade any weaker dollar trade here.
European markets on another planet. That's the headline from Emily Rowland of John Hancock. Whether you intended that to be the headline or not, it will be. Emily, thank you. Have a good weekend. Thank you, Emily. The euro right now, 109.92. Tom, European stocks, the Euro Stoxx 50, up something like 15% year to date. Not too far off what the S&P 500 has delivered.
We'll state that of all the different opinions we have on the show, the one constant theme has been surprise over Europe in the last 6, 8, 10 weeks as well. I would still suggest that we underplay the war reporting that we see day by day in Ukraine. It should be more in the discussion than it is.
If you are just tuning in, welcome to the program. The equity market right now on the S&P 500, negative by 0.05%. Coming up in about 48 minutes from now, Anne Maletti of Allspring Global Investments to weigh in on this equity market so far in this rally year today, and whether we can get that continued broadening out away from tech to the cyclicals. Bit of breaking news in the last 10 minutes, Tom. This from Sky Sports. Harry Kane now has permission to fly to Germany and undergo a medical at Bayern Munich.
Was that a Brexit thing?
$100 million plus transfer is set to go through between Tottenham and Bayern. A Brexit thing. I think that was Daniel Levy getting on the phone and trying to hammer out a few more details thing.
Explain to Americans who don't understand why Lionel Messi's in Miami, explain where Byron fits in.
What do you mean? What? Can you reframe that?
There's a lot of Americans that this is all like Greek.
Sport.
No, it's all Greek to most of us. We're worried about if the Reds have enough to get a wild card slot in the National League. John, who is Byron? What is the importance
Us
of
dumb
this?
Americans don't know anything. And you
No,
and
I've got to sit here and talk down to
I
everybody.
wouldn't know. Exactly. You
wouldn't
tell
know.
us exactly what we should be paying attention to.
I wouldn't know Byron from Dortmund if it hit me over the head. Who is Byron?
Heavyweight European football club based out of Germany.
They're like Real Madrid.
Well
done. They're like AC Milan. They're like Barcelona.
They're up there. They're competing for the top titles in European competitions every single year.
So when he plays a friendly or a UEFA, whatever it is, championship
that's not a
game
friendly, but yeah.
in England, that will be a big deal. The return.
If he
of
plays
Harry
a
Kane.
Champions League game in England, that would be a huge deal, particularly if he got to go home and play Tottenham. But you need to qualify for these competitions, Tom, first.
I'm learning every day.
Compete to try and win stuff and all of that. Vishy Tripatur of Morgan Stanley joining us in about 20 minutes from New York City. Equities negative. Good morning.
trillion industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Tuesday, in his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the country.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The goal of this executive order is to make sure that we're limiting the ability of financial flows and the know-how that often goes alongside those financial flows to give countries of concern the ability to get around the things that we're trying to prevent them from getting access to, like the most advanced semiconductors.
That country of concern in this instance is China. That was Wally Adeyemo, the U.S. Deputy Treasury Secretary, following the executive order from the President of the United States on outbound investment into China, trying to curb that, curtail it. The president also had something to say about China at a fundraiser in the last 24 hours. Yesterday evening, he referred to Communist Party leaders as, quote, bad folks, and went on to say, Lisa, this economy in China is, quote, a ticking time bomb. And that speaks to the data we've had out of China so far this week. Whether you'd quite go that far and characterize it as a ticking time bomb is up to you. The data on the loan side of things, Chinese banks extended the smallest amount of monthly loans since 2009. Lisa, this going together with the deflationary data early this week, it doesn't look too good over the last week.
And it raises a question of what China's going to do about it. And Peter Scheer was talking about that yesterday. And President Biden hinted at that as well. They're not going to take it sitting down. How are they going to try to generate growth? Is it going to be in other economies? Nonetheless, the message, the headline of, basically a ticking time bomb and bad folks is perhaps a little bit different than some of the conciliatory moves by members of his cabinet, as well as some paring back.
Does bad folks sound like an insult to you? Bad folks.
I would not want to be called bad folks.
Bad folks.
Okay, well, I mean, it's like trying to gather a certain type of tone ahead of a campaign.
What would that tone be?
We're not in it for China, basically.
Bad folks.
Yeah, bad folks. Well, you would never call someone bad folks.
That's
I mean, that's an insult.
No one calls anyone a bad folk.
If you come around here again, you're a bad folk.
Bad folks, TK. Bad folks.
Bad folks.
Bad folks. You got to speak, Tom. It's radio.
It's radio.
It's
You
radio.
gotta speak. Good
This is
morning
what
on
you do.
Bloomberg Radio.
You get the microphone.
Thank you.
Engage it and you talk. I've worked with you for a long time. If you're just tuning into this program and we're still keeping you, thank you. TK does this thing, and you have to know about it because it's really important. In radio, if you miss your cue and there is a moment of silence and you pick up and start talking, you own it. It's yours, because to the audience, you missed your cue. So what Tom does when he misses his cue and doesn't speak is he waits for someone else to own it for him.
The reason we do this is important. Jeanette Lowe's gonna have some patience here for us. This is really important. There's two kinds of people on TV: people that have done radio and people who have not done radio. And to John's point, which he's brilliant on, is silence is everything in this business. So when they're doing that, and I'm sitting here looking at the Red Sox, they got no chance against the Mariners. And the bottom line is you use the silence for showbiz and you extend it.
Yeah.
And then give it to someone else.
Yeah, and let someone else own it. Yeah.
Like that. Let's break the silence here with Jeanette Lowe, Never Silent, Managing Director of Policy Research at Strategas. She was at Richmond years ago at the Jefferson Hotel with that acclaimed Jefferson statue, and she figured out that if you make a law in Washington, everybody piles on and enhances the law. And your research note, Jeanette, I think is absolutely brilliant about now we're making policy about China. The president is making policy. Will we see Congress in various forms pile on and make our policy with China ever more limiting and restrictive?
Yeah, absolutely. So, I mean, we finally got the executive order that Biden has been heralding for quite a few months now. So we knew this was coming. It was definitely a little bit more limited in scope than originally thought. And you could already see members of Congress starting to put some messaging out both before the executive order actually hit and after it. And so what you see is that the administration is saying that they're going to focus on targeted products and services within AI, semiconductors, quantum computing, but the Treasury is going to now issue those rules and it's going to take some time to be implemented. Congress is already saying, you know, Senator Schumer has been on wanting to do legislation on China for quite some time. He's immediately said that he wants to now codify these restrictions that kind of came out of this executive order and refine them. You have members that are on the U.S.-China committee. So you have members that are, you know, the head of the Foreign Affairs Committee already saying they don't think that the executive order goes far enough. It should include other areas. So this is still the beginning stages. We still anticipate that we're going to see more coming out of Congress that's going to build on these restrictions. So even if we have this executive order now that we've been waiting for, there's still more to come, and they're going to still refine it, as they said in the executive order, kind of taking a look at what are these notifications of various use investments that we do have in China, and then figuring out where they may actually need to do more restrictions in the future.
Jeanette, some people are saying that the restrictions were severely curtailed from the original form and are actually very narrow and much less restrictive than previously thought, and that the reason why President Biden talked so harshly about China was to sort of distract or send the message that he was harder than his policies actually were. Do you agree with that type of sentiment?
So I think that the administration is trying to probably thread a couple lines. One is, you know, the U.S. is also, as you mentioned earlier, Biden is going into campaign mode. You know, you're going to have these speeches and these talks. Obviously, this wasn't a speech. This is more of a private fundraiser. But that they want to start showing that the U.S. economy is doing quite well and make this contrast with China. There has been the push that, you know, maybe Biden isn't being tough enough on China. But there is this, you know, we're trying to move it in stages and then build from there. So I think that to some extent, he would probably like to do more and faster. And that may be some reason behind some of his comments. But I think he also is trying to draw this line between the U.S. actually doing better and China not doing so well, but that we also need to do this for national security reasons.
I look, Jeanette, at China and what is assumed to be the response out of Washington. What will it mean for American business? Is this a political exercise, or can you bring it over to the total dearth of FDI that we see towards China?
Yeah, I mean, this is definitely one concrete step that we are taking, but at the same time, the administration is sending a message to businesses that China is more of a risk than it has been in the past, and that there is more of an effort that companies need to undertake if they are going to continue to do businesses in China. And the U.S. also wants to highlight some of the issues that we've seen with companies investing in China over the years, with joint ventures, having to give up data controls, things like that. But there is definitely, I think you're already seeing, you know, yes, we've had the CHIPS Act pass, but some of that funding hasn't even come out. You're seeing investment move to the U.S. already ahead of that. I think this executive order, even though the rules aren't in place, is still putting forth that environment for businesses where they have to reassess whether or not they want to be in China, take those risks into account, and consider moving supply chains or all of their business out of China overall, because more of these changes are coming.
Hey, Jeanette, wonderful to get you on the show. Come back soon. Jeanette Lowe there, a strategist. We appreciate it. Important to know, and we did this in the previous hour, but I think it's important to double down on it. These comments from the president came at a fundraiser, Tom, a fundraiser to donors in Park City, Utah. And this is what it's about now, to raise money for both the Democrats and Republicans. This just seems to be a box you've got to tick on a campaign trail. You've got to say things like the president said yesterday evening.
Playing to a domestic audience, and of course Beijing knows he's playing to a domestic audience, but they're going to use it for their own needs internationally and domestically as well. But yeah, I agree. What's unique here, and I thought Jeanette was just brilliant there, on the bipartisan nature of this. If Congress piles on and makes it more, just to use a general phrase, restrictive, who's going to push back? Who's going to say, let's think about this before we act?
You've made a couple of points there, Tom. I'm so pleased you made the first point, because so much of this is for public consumption. Publicly, China said they were disappointed by that outbound investment order. I think privately, they're probably a lot happier. It was more narrow than it could have been 12 months ago. So even for them, Tom, and you've made this point, it's for public consumption.
It's all, yeah.
We're disappointed. We're disappointed. But at the same time, Lisa, how much has changed?
Yes, although if you look at the data, and this to me really stands out, you're absolutely correct, by the way. Everyone would agree that basically the rhetoric has to be hardline, and then underneath there's the reality of needing a little bit of working together in order to keep both economies on the rails. There has been a divergence, though, between these two economies, which really goes down to the fundamental question of why have we not seen more of a read-through in the U.S. economic data with respect to what's going on abroad.
We'll continue this. Catherine Mann, I think, is brilliant in this. We'll talk about it here as we stay with us, folks.
Is Catherine Mann going to come on the phone?
Well, we're not going to get Catherine Mann on the phone, but her work on China-U.S. codependency is definitive.
It'd be good if we could make that happen.
I'll get the interns on it.
One day. Digital tour of Morgan Stanley on the fixed income market, on the bond market coming up shortly. Your equity market basically unchanged. From New York, this is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Let's get you to the weekend. I'm going to stop saying that now.
You said that like
four.
Where's my Tang?
I've got like a sign that holds
every
up
time
four.
John says that, I'm going to have a sip of Tang.
This is for the London desk, who might be playing a drinking game before they go to the pub. Just maybe. Maybe this is just for the audience in the City of London.
Someone dared you, didn't they?
Who are ready to call it a day at midday.
Is there anybody in the City of London in August?
Right
is
now?
it like Paris where
Friday.
everybody exits?
Did you see that meme? How funny was that?
Yeah.
About the US economy. It's like this guy calls this other guy and calls up and says, US economy's doing great, inflation's coming down, GDP's brilliant. You know, speaking down to the European market participant, and they just get an out of office reply that we're out of office until September 20th. Love that.
The heart of the matter there, John, is because I know we got to move forward. France has the same productivity America working, I believe it's 18% less. That's the math, folks. It's irrefutable.
Can't fight it. Can't fight it. Under surveillance this morning, the latest out of China. China's economy showing further signs of weakening. New loans from Chinese banks in July plunging to the lowest level since 2009. Just adding this week, TK, to a slew of recent negative data out of the world's second largest economy.
Reading this weekend, there'll be lots to read about this. It's important to be informed about the nuances. I'm going to go back to the heart of the matter, which is people look at this China, America, China, China, America, China, baloney. Look at Vietnam. Look at Malaysia. Look at Mexico. Look at a good part of South America. This is a more complex discussion than the simplicity the politicians speak of.
President Biden called them bad folks, but it's been bad data all week.
And how much does this lead to a real shift in the strategy by China? And I keep going back to what Pete Scheer said of Academy Securities when he was saying you're going to see Chinese companies try to compete more directly with U.S. companies in Latin America and Africa. There is going to be some new sort of alliances that are drawn more severely that I think are going to have to come to the fore.
Quote of the week. Quote of the week. Can we start doing that? That would be fun. Quote of the week this week came from the President of the United States, and it was not about China. It was about the Inflation Reduction Act. You could not make this up. Republicans could have written this for him. He said he regrets the name of the Inflation Reduction Act, saying it, quote, has less to do with reducing inflation than providing alternatives where we generate economic growth. He said a little bit more than that, but Lisa, ultimately, wasn't that the complaint on the other side of the aisle down in Washington before this got passed?
So everyone was saying it was called the Inflation Reduction Act to get it passed, because how can you vote against the Inflation Reduction Act at a time where you've got the fastest pace of inflation going back 40 years? Who's going to fight against bringing down inflation? And now people are wondering how much this is actually fueling some of the sustained growth that we've continued to see. Look, I mean, either way, he's saying the quiet parts out loud, right? And the issue is it is fueling some growth, and he's trying to now put the emphasis on that because it isn't
he wants to
necessarily...
own the growth because inflation is coming down.
Yeah, because inflation isn't necessarily the plan.
I think the president could go on the president could go on Wall Street Week with Larry Summers. It'd be interesting.
That would be a great conversation, wouldn't it?
To see the balance here between inflation and growth. That's always what it's
I'm
about.
not sure the president wants actual questions at the moment.
I'm not
you know how that works.
Go there. I'm in the Jeff Curry timeout chair as it is.
Well, you're in trouble for that comment. Yeah, okay. GM and
What
Ford
else?
recovering a bit this morning. Yesterday, the biggest one-day loss of the year so far for the likes of General Motors. This drop coming on concerns that demands by union leaders could send labour costs there absolutely soaring. Labour power in the last couple of weeks back on the agenda, Lisa, even as we talk about disinflation more and more day after day.
And it has been, but it's been building. And this idea that suddenly the new playbook for so many investors is going to be looking around which companies are most susceptible to organized labor and pressures to increase costs. For each of these companies, it was what, $80 billion in extra cost for each of them if some of these demands were brought to the fore. I just want to say, even for companies, though, who do not have that kind of union pressure, what does it do to the wages that they need to offer if you can get that kind of wage growth? If you can get $170,000 to be a truck driver at UPS, what does that do to FedEx? What does that do to others?
To Tesla, you think it can have an impact?
Tesla is a bit of its own animal, but there is this question around what the broader impact is when you can get that kind of competitive wage at the place.
So here's my question. Are they hiring? They're putting up wages for union workers at UPS. We're seeing a big deal there. Are they going to be hiring truck drivers anytime soon en masse?
It's a good question. In other words, are they basically in a vacuum where they're paying people more but not affecting the labor market in a material way because they've got no choice? I don't know the answer to that, but there was a story talking about how FedEx is getting increasing pressure, and all of a sudden other workers in that same industry are starting to raise a lot of pressure. So even if they aren't hiring and affecting the labor market directly, indirectly, there is a pretty significant impact on increasing wages.
It's been a massive conversation. You've seen the memes out on X, on Twitter, UPS drivers driving Lamborghinis and all of those kind of things.
I mean, in fairness, it is a living wage with some of the increases in prices, depending on where you live. It's more than that in some places. But it's trying to harken back to the 1950s or a time where
why are you
one
looking
person,
at me when you're harking back to the
one
1950s?
person, I'm going to look at nobody. I'm going to look at you. When one person could go to work and then support a family. You can't do that anymore.
One vignette. I'm in Davos. It's freezing out. I'm with a CEO of a fancy health company.
So in touch with the people.
John, the CEO of the health company said 1/5 of my people can't afford to get to work every morning.
What was his bonus that year?
Oh, yeah, his bonus was huge, but he tried to fix it, and he got a lot of board pushback here on the atomization of labor over the last 20 years.
Drives me nuts about Davos. That does. I just.
Yeah. Well, we're gonna go back, and we'll be more ecumenical than that. We ready to go here?
We are.
We have an important guest here on a Friday morning. Vishy Tirupati joins us, Chief Fixed Income Strategist at Morgan Stanley. We had on Vishy Alexander Goldfarb, real estate axe at Piper Sandler the other day. He's quoted in Cranes on SL Green and what's out there, which you nail in your research note. We have ahead a massive refinancing. What's going to be the ramifications of refinancing in this new environment for fixed income?
I think you're specifically talking about, specifically commercial real estate. There is definitely a refinancing challenge ahead of us, but I think there are significant and important nuances that we need to take into account. I think in terms of type of properties, in office properties, there is clearly a secular change in terms of flexibility from working from home, et cetera, that has reduced significantly the demand for the office space. So there is a significant headwind for that particular property type. But you look at some of the other property types, whether it's multifamily housing, industrial, commercial real estate, et cetera, the challenges are not exactly the same. But I think the bigger issue in my mind is really that from a lender type perspective, the biggest exposure to the commercial real estate as a whole is in the smaller regional banks that also happen to be the weakest link in the lending chain. So that is the real challenge, not commercial real estate all around. There are important nuances to focus on.
If there is fear, and if the pendulum's swinging price down, yield up, which type of fixed income instrument is an uncommon value right now?
I think there are a number of places we would point to. A lot of the senior tranches of securitized products that have actually fallen out of favor because of the bank demand for these products has fallen off, and that has clearly kept those spreads much wider. So there's a range of such senior tranches of various securitizations we think are pretty attractive. We continue to think that the higher quality fixed income, including treasuries and high quality investment grade, continue to offer reasonable returns going forward.
What do you make of what Emily Rowland was talking about earlier of John Hancock, where she was saying that some of the price action in bonds doesn't make a lot of sense this week, considering that we got disappointing data, we actually do have disinflation, and suddenly people are gaming out higher inflation for longer and a Fed that backs off way too soon? It's
a head scratcher for sure, because yesterday's data, we had inflation surprising modestly to the downside, well in line with the trajectory is well in line with what we think is going to be a lower inflation trend for the next few months, the next several months. The expectations of the budget deficit numbers that were the monthly numbers were a bit of an upside surprise, but we think that how much that one specific number played out in the market seems like a vastly overdone in our minds. I think the narrative that has taken hold in the market, which we disagree with, is that the term premia are going to be higher for longer, and we completely disagree with that notion.
So if that's the case, have you been buying 30-year treasuries in mass? Are you basically seeing this as one of the best buying opportunities that you've seen in a long time?
We're definitely suggesting investors go long duration. We think the five-year spot is the sweet spot at this point. We've not yet made the call on the 30-year part, but I think all of these types of sell-offs, that we are seeing in the market, we think of them as opportunities to go long treasuries. We think as we will see a more dovish tone coming from the policymakers over the course of the year, and the market narrative we think will shift in favor of being long duration.
Interesting. Just starting to hear that a little bit more from Fed officials in the last couple of days. I'm thinking of John Williams of the New York Fed and the New York Times earlier this week. Vishy, love to catch up with you going into the weekend. Thank you, sir. Have a good one. Vishy Tripatur there of Morgan Stanley. Sometimes you've got to stay on top of ridiculous stories, and I think you're all familiar with the prospect of a fight between Elon Musk of Tesla and Mark Zuckerberg of Meta, respectively. Mark Zuckerberg said that he'd offered to have this cage fight, if you want to call it that, on August 26th. No sign of a date being agreed here, but Elon Musk saying this moments ago, the fight will be managed by Mayan Zuck's foundations, not UFC. Live stream will be on this platform and Meta. Everything in camera frame will be ancient Rome, nothing modern at all. I've spoken to the Prime Minister of Italy and the Minister of Culture. They have agreed on an epic location. I'd love to hear what the Italian Prime Minister Meloni has got to say about all of this happening, Tom. No date. I thought we were getting a back scan earlier this week. Weren't we getting a back scan?
He might need surgery.
How did that go? Still don't know.
At least it's like totally on this story.
That post came out just seconds ago.
Is this to raise
minutes
money?
ago.
I'm lost. Is this to raise money?
It's that they challenge each other. Didn't Elon Musk originally challenged Mark Zuckerberg to a cage fight in direct response to the creation of Threads? And Mark Zuckerberg basically said, bring it on. He's been training. He looks completely jacked.
He's shredded.
He's shredded. And Elon Musk is not. And then they're talking about possibly doing this. I personally think Elon Musk is the chief executive troll of the world. Because at what point is he being serious? I mean, ancient Rome?
No idea.
We have no clue. Maybe he is.
Okay, but we need Scarlett Fu, surveillance culture correspondent, on this. And I would, she's like third-wired into all of this. And I would say
she's
to
an ice
Scarlett,
hockey fan, not a UFC fan.
Whatever. I would say to Scarlett, what's the why of this? How did we get here, Mr. Farrow?
Well, I hope that we can raise some money for charity. And if it goes to a good cause, that's a good thing.
Yes.
Who are you?
Yes.
That's not.
That's a good thing, isn't it? No?
Sure, but that's not the point.
Was this
the
like
point
a
here
dare?
is the point here is Elon Musk was mad at Mark Zuckerberg. Somehow Mark Zuckerberg starts looking good. He was the most unpopular figure in corporate America. Suddenly, maybe not.
If you're just tuning in, welcome to the program. The S&P 500 negative here by 0.1%. Coming up in about 45 minutes from now, Andrew Hoddenhorst of Citi. Andrew, looking for the potential of inflation re-accelerating and reintroducing the risk of more rate hikes maybe into next year. He's in the Neil Dutter camp, or maybe Dutter's in the Hollenhorst camp, but they're in the same one.
I would say for Global Wall Street, this is the Friday interview. We need to really listen to Dr. Hollenhorst here about the sticky inflation, or dare I say lift in inflation. That's an outlier call this Friday.
Conversation on retail coming up. Looking forward to this. Lots happening in that space recently, particularly in luxury. Joe Feldman of the Telsey Advisory Group looking ahead to retail earnings. We'll catch up with Joe in just a moment. What's Joe got to say recently, Tom?
Joe's readjusting on big boxes as well, and Dana Telsey was definitive this morning on the Coach Michael Kors transaction. We can talk about that.
What did Dana say?
She said that they underpaid nicely versus the gross overpayment for Versace of years ago. The stupidity of buying James Chu and Versace at huge numbers.
Or James.
Oh, it's Jimmy? I didn't know. Sorry, that was James.
We call it Jimmy. Chu.
Excuse
say we loosely, obviously. Equities negative here on the S&P from New York. Good morning.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year, and so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I don't think the Fed has done enough. And I think the Fed is kind of enamored with this soft landing view. They're almost wish casting this outlook. And I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up, sometime next year.
We are definitely borrowing that. Wish casting. Neil Dutta, head of US economic research over at Renaissance Macro Research, who thinks there's real potential for this economy to reaccelerate and take inflation with it, questioning whether the Fed's work is really done. Let's turn to the price action for you this Friday morning. Good morning to you all. On the equity market on the S&P 500, equity futures down by 0.1%. The arc of earnings season, I think you all know it well. The banks go first, then comes tech. Personally, not a big fan of the bank earnings story. I like tech because it has such big weighting on the S&P 500. Then I like to turn to retail towards the back end. Retail target on Wednesday. So next Wednesday target, Tom. Day after on Thursday. So next Thursday, August 17th, you'll get numbers out of Walmart. So retail takes over the earnings season for next week.
They're different, too. They're nuanced. We're going to get to that with Joe Feldman in a moment. But, John, I totally take your point. It's like UPS. It's a spread of the nation, FedEx or whatever. But to me, they're each different. I think the financial media lumps them all in like we do with tech. They're all big box, all the same. And the answer is they're not.
Different weightings to merchandise and apparel and all of that good stuff, and food and grocery. It all matters.
On a Friday, to brief you forward on this and into next week, Joseph Feldman joins us, senior research analyst. He's working with Dana Telsey at the Telsey Advisory Group. They've been on fire the last 48 hours. Joe, I want to get to big box, but I really want to frame out the difference here. At Target, I've got a women's boxy zip-up denim jacket, Wild Fable blue denim, for $35. That's what you're looking at. Your colleague in crime, Dana Telsey's, looking at the Medusa 95 Dua Lipa denim jacket over at Versace for $1,350. When all this is done 3 years out, is there going to be anything left in the middle between Coach, Kors, Versace, or LVMH and Target? What's the middle end up doing in the coming years?
Yeah, the middle is kind of squeezed right now, and that's where we're seeing that middle has been trading down, and then the upper end is kind of staying where they are. It's that aspirational customer has traded down a little, the middle has traded down, so I think that still positions Target and Walmart pretty well. Dana, I think, likes the deal with Tapestry and Capri in the sense that you can bring these two companies together. They're a house of brands. And I know they're more of those middle aspirational type brands, but you can operate them more efficiently. And maybe the way you allocate resources to the different brands and do the back end can make it more profitable and make them more of a stronger venture to go forward. So I think that we kind of like that lineup and the strategy there. And, honestly, the Capri side has been kind of languishing for a little bit. And so I think that now if you put it together, you could maybe make a go of it, make it stronger. That all said, the near term, the consumer is still under a lot of pressure. Discretionary sales have been slow, and especially big ticket discretionary sales have been slow. And so that's where we're at heading into this earnings season, and why we like Walmart into the earnings season.
Well, Walmart year to date outperforming Target by a massive margin, underperformance from Target, outperformance from Walmart. Joe, there's a word I really don't like around the retail names. It's shrink. Why don't they just call it what it is? Theft. And how much are we going to be talking about that next week?
Yeah, I think we're going to hear a lot about shrink next week. Target has laid it out and told us, they're expecting around 500 million of incremental shrink this year. Walmart's got a big number as well. Now, they haven't quantified it, but it is big. And Home Depot and Lowe's and Best Buy, and you go down the list, and it's been a big problem for everybody. I mean, theft has really kicked in higher. The shrink side, yeah, there's always been damages, returns that you can't really sell, things that maybe walk out the store with an employee every once in a while, things like that. But this organized crime that's happening in retail is really a big problem especially for these big box retailers. Dana actually recently was in Beverly Hills and witnessed it firsthand, one of those grab and goes, somebody just running out of a high-end store and literally right in front of her. And it's frustrating to see, and it's scary for the average consumer to see that happen.
And it's something that we've seen particularly with respect to a lot of drugstores, particularly in city centers. I'm wondering how much this pushes the emphasis then on the online presences of some of these companies. And I think of Walmart in particular, which is actually putting up competition to the likes of Amazon with what they can offer in e-commerce.
Yeah, absolutely. I mean, the e-commerce side of the business at Walmart, at Target, really many of the big boxes have improved significantly. They're very robust, and we see Walmart as going toe-to-toe with Amazon, especially on the retail side of the business. Clearly, Walmart doesn't have AWS, but on the retail side and the physical presence, to leverage the physical with the digital is a real advantage, especially relative to Amazon at the moment. Now, Amazon wants to get more physical. They're trying to open grocery stores. I think we'll see that accelerate once they've kind of figured out the box that they want. But there's definitely, this conflict is going to be around for a while. And you can get great value at both of these retailers. Add in Target, add in Costco, add in all the other big box guys. And you're absolutely right. That is a way around this. We have seen e-commerce sales decelerate a little bit, broadly speaking, in retail, as people have returned to the stores a bit more. But that's definitely a strong area of opportunity for the retailers going forward.
Walmart's kind of a confusing read on the U.S. consumer, because on one hand, if it does well, that's a good thing. People are spending money. On the other hand, it's been people who are trading down, who are trying to spend less, who are going from Whole Foods or Whole Paycheck, as Tom likes to call it, to Walmart and looking for a bargain. So is Walmart's gain everybody else's pain? Is it sort of a counter indicator of consumer strength?
Well, that's a great point. That it is an indicator of where the health of the consumer is. Now, the good sign is the consumer is still spending. They are trying to save money. They may be trading down. They may be trading in. But Walmart has done a really good job over the past few years and making their business model stickier. And so they're retaining a lot of those customers. So they've seen trade down and trade into the business, but they're seeing those people stay. So yes, that's not great for the rest of retail. It just shows that Walmart's gaining market share. But some of their latest formats, like especially the ones over in New Jersey, if you just cross the river, they're really phenomenal stores. And they're very much Target-like, to be quite honest. It has that little slightly more upscale feel, really goes after the core American consumer. And you're absolutely right. We are concerned about how things will shape up, especially for that middle-income consumer for this holiday season.
So, Joe, we talked a little bit about the prospect of trade down to Walmart. We've heard that over the last few quarters from the company itself on the earnings call. Joe, what about holding on to talent? We've seen a bit of softening in the labor market. You're talking about maybe the economy deteriorating. Do they have that issue on the talent side? Do they have a UPS problem? Do they have a problem like GM, Ford?
I don't think so. I think Walmart and Target and all these guys have done a really good job over the past few years of trying to pay their people better, to raise wages, starting wages, I should say, and raise the average wage for everybody. They've added more benefits to their to their employees, and they've done a much better job with that. And we haven't heard as much of the griping that we used to hear a few years ago, especially around Walmart or Target or some of the others, that employees felt underpaid.
I asked for obvious reasons, Joe, and I'm jumping in because we've only got about 60 seconds left. I can only imagine how difficult it would be to work at some of those stores in certain locations, at Target, at CVS, when you're seeing people come in, clear off the shelves, and you're told that you can't intervene, you can't do anything, you've just got to step back and watch it. What's happening to those locations? Are they just being shut down?
Unfortunately, some have been. I mean, you saw Walmart shut down a couple of stores in Chicago. Others have shut down stores in San Francisco and other parts of the country. The retailers tell us there's definitely isolated pockets and they're limited to certain stores. It's not everywhere, but it's a concern, and it's scary for employees. It's scary for the shopper while you're there. And it's very frustrating too. I mean, we keep hearing stories of employees that occasionally step in, and when they're told not to, and yet it's just so frustrating to them that they step in and try to stop it. And some have actually lost their jobs for doing so, because it does put them at risk, it puts the company at risk, and puts everybody, the shopper at risk as well. So it's best to let the people go, but very frustrating for sure.
Some shocking images. Joe, thank you, sir. Joe Feldman there of the Telsey Advisory Group, going into earnings next week. Tom, from the likes of Target and Walmart, Wednesday and Thursday.
Well, I'm glad you brought this up. It's an original landscape. I totally take your point on shrink as being a homogenized theft as well. To me, and this is in New York, it's a huge issue. You go into the store, little plastic windows with a little bit of keys, turn around, go out, order it online. That's my response. I think it's a changed landscape, to say the least.
Anne Milletti of Allspring Global Investments coming up, live from New York City. Good morning.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I got a Bitcoin tattoo. Somebody came out and was like, when will you get a Terra tattoo? And then Terra was probably trading at $4 or $5. And I flippantly said, if it gets to 100. And so when it got to 100, a man of my word, I got a tattoo.
The economy's been pretty impervious to the Fed's increase in rates.
Sooner or later, this economy will stumble.
We are seeing deterioration in broad fundamentals.
Right now, it still feels like the economy is doing a bit more than they would be comfortable with.
I think the economy is growing above trend. I don't think the Fed has done enough.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. It's just Friday is what it is here. It is a Friday in the summer, and we are recalibrating forward to August, into September, on our way to Jackson Hole. And the big change this week, John, disinflation. It's out there somewhere.
Endorsing a pause so far for September 20. Does it validate a pivot? I don't think we're quite there yet. You've got some people on the one side, Tom, talking about a reacceleration. Neil Dutta, Citi, Andrew Hollenhorst, others as well. We'll catch up with Andrew a little bit later this hour, I believe. Others who believe, Tom, that we're done. It is time to maybe go on a victory lap. This Fed, though, perhaps nervous about doing so, embracing that view. Given the risk, the potential, Tom, they might be wrong. And we've been asking that question. What is the biggest risk right now? Waiting too long to reduce and pull back, or...
They always wait too long. That's the history.
Or going too soon and pulling back.
Too long. Yeah, I thought Jason Furman was brilliant yesterday at Harvard. We don't give our opinion out ever, do we? We never give our opinion.
No.
But the debate here this morning is, do you look at a one-year view, a longer-term view, like Jim Bianco, like Andrew Hollenhorst is, John? Really looking forward to that conversation. Or do you take a more short-termism, 6-month view? Steve Englander featured on his note the 6-month annualized disinflation.
It's come down.
Yeah.
Steve thinks they're done. Steve was talking about cutting interest rates first quarter of next year. Still a pretty divided view on things. I would say if you're a Fed official and you've got to take that prudent approach, Tom, as a policymaker, where the number one rule is do no harm. Do you want to declare victory when you've still got one more CPI print, one more payrolls print before September 20th? Perhaps a little bit too early. We did get a glimpse of it, though. That New York Fed interview, John Williams in the New York Times, I think is somewhat revealing, even though it's incredibly intuitive to suggest that when inflation comes down, if nominal rates are held steady, real rates increase, and we might need to do something about that and adjust. Just entertaining the conversation about rate cuts in any way, shape, or form is a step away from what we've been doing over the last 12 months at the Fed.
The math of the nominal rate less inflation or deflation. There's a whole debate there to the residual. That was what John Williams was looking at. At least I didn't get to Joe Feldman on this with Amazon, but they're going to blow up their grocery business. And I would suggest a lot of people listening and watching this are saying, okay, you can have your bow tie wonk inflation debate. It doesn't matter. I'm getting killed at the grocery store. That's the emotion out there, that even with disinflation in the wind.
Which raises this issue around commodity prices. And we've seen some of the oil prices climb up and gasoline prices climb up. And all of a sudden, when does that affect sentiment? But it kind of feeds to the deflation debate, right? If people are feeling like prices are just too high, when do they start pushing back? Do companies still have the same kind of pricing power?
That, to me, is the key.
And John's been asking it, you've been asking it. But this, to me, is the question at a time when prices are so much higher on a relative basis, they can't keep creeping higher at this kind of pace. So have we seen that? Not in every area. You still see hotel prices. Have you tried to book a hotel recently?
They're insane.
I know.
It's worse than airlines.
Constantly doing vacation.
It's
sort of,
You're very European.
Bramo's so Euro now. It's great.
She's like Euro.
It's brilliant.
She's on a first-name basis with Hartsfield called baristas. That was good. I mean, but the hotel thing is more serious. Actually, it's actually absolutely insane worldwide. Of getting a hotel is a battle.
But just pushing this forward, if you do have wage increases, down the line, some of the staples, how much does that bleed into higher rates for a lot of things? The hotels are a perfect example of that because of how hard it was for them to hire enough people after the pandemic.
But the issue here we're having is it seems like forever to the next Fed meeting. That's really what this debate is about. This is the Fed cycle into September after Jackson Hole.
We've got that Jackson Hole split.
It's out there somewhere.
So we should hear from Chairman Powell towards the end of the month for an update. Do you want an update on this? Elon Musk, Tom.
Oh,
if you are just tuning in, I'll share it with you. So Elon and this fight potentially between him and Mark Zuckerberg. The fight will be managed by Zuck and My foundations, not UFC. Live stream on Meta, on this platform too, X, formerly known as Twitter. Everything in camera frame will be ancient Rome, nothing modern at all. He spoke to the Prime Minister of Italy, the Minister of Culture. They've agreed on an epic location. Everything done will pay respect to the past and present Italy. Preach, Elon. When's it going to happen? Okay, when's it going to happen? He responded to, how was the MRI? On Twitter. I spent 3 hours in an MRI machine on Monday. Bottom line is that my C5, C6 fusion is solid. It's not an issue. Real athlete stuff here, Tom. However, there is a problem with my right shoulder blade rubbing against my ribs, which requires minor surgery. Recovery will only take a few months. You know, when he says stuff, I don't know if he's joking.
Nobody does.
What is he talking about?
He's giving
his shoulder
medical
blade
update.
against his ribs.
What's great about this?
I just think he's
where
trolling
this
us.
is heading, Lisa, is
Where
you,
is it
you
heading?
and I are going to step aside, and this screams Bloomberg, Francine Lacroix, and John Farrell from the Colosseum in Rome. You know they're going to do it at the
I would be
Colosseum.
very happy to commentate on that. But I imagine Joe Rogan would love to commentate on it too.
I just could see
Rogan on this would be awesome.
I mean, I can see you.
Rogen.
I mean, I can see you doing it. Can you see Francine Lacroix doing the blow-by-blow in the Colosseum in Rome? It'd be great.
All I'm going to say is one guy's shredded, one guy isn't. One guy knows jiu-jitsu, the other one not so much. And the guy who knows jiu-jitsu is probably the one who's going to win, and that guy's Zuck, isn't it?
I
Yeah.
hope they raise a lot of money for.
So do I. I said
for
the same
good
thing.
causes.
So do I.
If
So
they
do
can
I.
buy a college education for every kid in Rome while they do this, that's
awesome.
That's a really cool thing. We staggered forward here in the 8 o'clock open on a Friday. We're going to do a data check right now. John and I will try to stagger through. John, I'm going to look at VIX center tendency. 12, 13, out to 17, angst, OMG, we're all going to die at 15.75. I'm going to call the VIX center tendency.
I'll keep it brief, Tom. We're down on the week, we're down on the session, we're down about 0.1% this morning. Yields were up yesterday, soft 30-year auction this morning, Tom. We're down about a basis point on a 10-year. 4.0, let's call it 4.1% on a 10-year maturity this morning.
Right now, we're going to dive into a look at growth in value, or the growthiness of value. We can do this with Ann Maletti, head of active equity at Allspring Global Investments. And I got 8 ways to go here, but I'm going to start with, I looked at one of your large cap value holdings, and your value stock at the top of the pile happens to be Google in this one portfolio. Alphabet. Is tech value or growthy right now?
It's an excellent question, Tom, and I think it depends on the name you're looking at and obviously the growth rate of some of these companies and the cash flow they're producing. And those are the things that our investment teams are really, really focused on. And so, you know, you could find value in a tech name, whether they're large cap or small cap, depending on the way you look at it. And I think we've seen this throughout. You picked a big name. What I see even more often in our portfolios is our managers steering away from some of the most popular names and into the names that have been, you know, really ignored by the rest of the market.
So some people might say this is the longest losing streak for the NASDAQ. Other people would say, actually, this is a sign that the rally is broadening out and that there's real momentum and strength in the U.S. economy and the U.S. equity markets. Which is it from your vantage point? Is this the beginning of a sell-off that's more protracted or the beginning of a broadening out that can be more sustainable?
You know, it's $1 million question, Lisa. And I think what we really need to do is remain humble. And, you know, we don't have the crystal ball. We don't know. But what we are paying attention to very much is what we're hearing, not necessarily hearing, let me make that clear, but what we're seeing from companies and the actions that they're taking. And what that suggests to us is that there's a lot of fog in the future and that, you know, it's clear that the future is going to be different than the past, i.e., for sure, higher rates for longer, and that does affect business models. And so we're starting to see management teams adjust to that, which is a good thing. That being said, we think some companies are going to be set up better for the future than others.
Well, how do you view the whole GM and Ford sell-off of yesterday and this question around unions pushing for greater benefits, bigger wage increases, what we saw over at UPS? How much is that trend influencing how you analyze each company?
You know, Lisa, you're hitting on some really important things because you're going back to the fundamentals of companies, which we are very, very focused on. And it's things like labor costs. It's things like, potential deglobalization. It's things like that really can impact company margins. And, we all know what margins have done over the last decade. Steadily, they have gone up. There's real question marks whether or not they can, continue to go up. We think that's probably not possible, but can they stay where they're at? And I think that's the challenge, and you're hitting on some of those key points, and that's why we're very much focused on bottom-up company fundamentals and, specific stocks.
Yeah, Melody, if I run through Allspring, what I see is, and we're going to get a little mathy here, folks, this is the R squared, the idea of the correlation of a given portfolio to the broad index, usually the Standard & Poor's 500. The fact is, and a lot of institutional portfolios are running active management very close to the index R squared. Where are you on that? Does the active manager need to get more active and disparate from the index? Or should we just all go out and buy the Allspring Index Fund?
It's a great question, Tom. And I think when you look at it across any asset manager, you're going to see a weighted shift toward a higher number than you'd like. But I think what we're suggesting is you have to get more active in this environment, because if you look at those higher weighted names in the index, not only have they exploded in terms of weighting in the index, but they've exploded in terms of valuation. I was talking to one of our growth managers earlier this week, and we were talking about the Russell 1000. And, he gave me some stats, and let me just read them really quick so I don't get them wrong. But, the PE of the benchmark at the beginning of the year, looking forward, started around 21 times. It's gone to 26 times during the same period, or up about 25%. And if you look at the rest of the benchmark, you could pretty much say there's been contraction in the rest of the benchmark if you just took away those largest 7 names. And so it's things like that that really make us go, okay, regardless of the macro environment, there are names that are clearly not being treated as equals. And so you need to get more active. You need to look where other people aren't looking and steer away from some of those large bets that you're getting when you just play an index.
Multiple expansion has been phenomenal year today, and thanks for that, Anne Meletti of Allspring there. If you're just tuning in, welcome to the program. The S&P 500 negative here by about 0.1%. Looking forward to this conversation. I think this is the number one for us, Tom, on the economy. Andrew Honenhorst, chief US economist over at Citi, does not think the Fed is done. He's looking for another hike potentially in November, sees all the ingredients for a re-acceleration in inflation later on this year. So park your soft landing hopes and dreams. Andrew's going to upset them in about 20 minutes' time.
This is an important conversation. The overlay here just out moments ago from the new Bridgewater, Kate Dunbar, Josh Moriarty, and Nicole Kagan, is the idea of the stasis that Jim Bianco talks about. Is this the new 2% level we're at right now? They talk about this mass extrapolation down to disinflation. John Williams R-starred way, way lower. And what Bridgewater's saying is maybe we're here.
Jim Bianco thinks inflation has bottomed, bottomed for the year. And through the rest of the year, things will get harder. Coming up shortly, Congressman French Hill, Republican from Arkansas. That conversation just around the corner. Your equity market on the S&P 500, slightly softer on the S&P. We're negative here by 0.1%. Yields going nowhere. 4.1% on a 10-year. The weekend, hours away. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. The markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
Senator Schumer has been on wanting to do legislation on China for quite some time. He's immediately said that he wants to now codify these restrictions. You have members that are on the U.S.-China committee. So you have members that are, the head of the Foreign Affairs Committee already saying they don't think that the executive order goes far enough. It should include other areas. So this is still the beginning stages. We still anticipate that we're going to see more coming out of Congress.
That was Jeanette Lowe of Strategas on that outbound investment order from the president earlier this week, curtailing investment in certain parts of the Chinese economy to some extent, and we'll talk about to what extent in just a moment. If you are just tuning in, we're 15 minutes away or so from PPI data in America. CPI speaking to that disinflationary trend of the last couple of months. Let's see if that shows up in PPI a little bit later this morning. That data drops at 8:30 Eastern time. Going into that, the equity market's set up as follows. The scores look like this. We're down by 0.1% on the S&P 500. The bond market's steady after the sell-off of yesterday, driven by a softer 30-year auction yesterday afternoon. Maybe some hawkish tones relative to what you might expect from Fed officials, given what the data looked like yesterday. San Francisco Fed President Mary Daly speaking to Yahoo Finance, suggesting there was more work to be done. The bond market's stable now. In the FX market, the dollar a little weaker, Tom, the euro a little stronger. We are just south of 110 on that currency pair.
I'm watching euro yen, John, rounded up to 159, 158.93. That's beneath the radar this week, but into the weekend and into the China-Asia opening Sunday, our evening, that's going to be interesting to see. A 160 print there would be newsmaking.
China is on the radar big time after that loan data that we had. And if you missed that and you are just catching up, Chinese banks extended the smallest amount of monthly loans going back to 2009 in the month of July, sparking a bigger conversation today going into the weekend about the prospect of maybe some central bank easing. To Lisa's point, though, does it make a difference in that economy right now? Does it make a difference at all?
I think it's a jumble. I don't have any wisdom on it. What I will say is it is front and center into the weekend. In the zeitgeist, it's about, yes, U.S., China, China, U.S., but also the complexities of other nations as well. We have an expert on this, the banker from Arkansas, the Republican French Hill joins us this morning. French, you in Arkansas live this. You're absolutely front and center on agriculture. I'll use Tyson's as the iconic chicken maker, and also pork, and the simplicity that's in the political dialogue versus the complexities of chicken from America to China, chicken from Brazil to China, and the stew of it all, not to use a pun here. What is your best policy with China, given the complex realities of a multinational export-import reality?
Well, Tom, Jonathan, great to be with you. Yeah, this is a super complex issue. You know, we're not confronted with a Cold War situation like we had in the 1950s to the 1990s with the Soviet Union, where we were not an integrated economy there. The case is exactly the opposite with China, for Japan, for South Korea, for Taiwan, for the United States, and for the EU. So first of all, I think your comment has to be thought of in a multilateral way, because all these developed economies have supply chain and market revenue opportunity in China. This de-risking that we're seeing, led by the private sector, I think is one of the most important components of why you see concern in China. And I hope that's the case, because in my view, economic deterrence to Beijing is one of the most important things that we can do on a multilateral basis to keep them from being provocative vis-a-vis Taiwan or the South China Sea. And I think that's a key point.
French, we're thrilled to have you on, as you are the only Republican that will not be debating here at the end of the month. It's good to see at least one Republican won't be up on stage. But French, can all of Washington, Democrat and Republican, the bipartisan China view, can we have an adult, multilateral, and complex discussion? Or are we just going to end up with silly simplicities that we hear and listen to now?
Yeah. Such a good point, and that's why I think Mike Gallagher, who chairs the China Select Committee on behalf of Speaker McCarthy, has got a good worldview. He comes from obviously a military background, but he understands these global capital market and trade market complexities that are multilateral and not solely with the United States. And that's why I was glad to see the G7 countries think about a reverse CFIUS type approach at the G7 meeting. This is the essence of where Joe Biden's going with his executive order yesterday. I do agree that I think it's more complicated. I don't think it goes far enough because everything in China is a dual-use technology, and that's how they operate. So it makes very hard for us to monitor and think about how to limit capital flows or technology flows into China.
That's the China story. There's a very big domestic story that was highlighted last week by Fitch that a lot of people are discussing, especially in light of the auctions, which were okay to poor as the week went on. One thing that Michael Zezas of Morgan Stanley said in a recent note was, we're taking seriously the risk of a government shutdown this fall. Do you think that a government shutdown should be on the table in order to reduce the deficit?
Well, Lisa, here's my view. The House is behind the curve here. We need to pass the other 11 appropriations bills that we did not get to in July. We passed one. We need to pass all 12. That gives us the maximum negotiation capability on behalf of the House of Representatives with the Senate and with the Biden administration to get the kind of spending deal that we anticipated from the debt ceiling negotiations. We want to hold the line on that. And the best way we can do it is to get our work done on the appropriations bill in the short time remaining. Those conversations are going on every day. Secondly, look, if we can't get all that done before September 30th, I think a short-term continuing resolution in order to get that work done is important. We don't need to go into a government shutdown when we've done the hard work through the debt ceiling negotiation, and we've done the hard work in our committees, both in the House and Senate, on the appropriations process.
Is there enough unity right now within the Republican Congress members and senators to really get an agreement that everyone can get on board with, because it was splintered in order to get anything through? Is that one of the big obstacles for you?
Yeah, I think it is, Lisa. I think we are talking with our members every day, as we've done all year, as we've accomplished, I think, a broad set of solid policy accomplishments this year, that some of which have even gone to President Biden's desk. We have to do that on each of these appropriations bills. You've got concern about each one from different members of the Republican conference, and I think that's good. I think it's constructive. We can handle some of that with amendments on the floor, but we do need to get these bills moved forward because, look, that maximizes our negotiating clout, and I would say to my Republican colleagues, if you go to a continuing resolution and don't do your work, what you're doing is essentially institutionalizing Nancy Pelosi and Joe Biden's spending levels of last year and their policy positions, which is not something that House Republicans are in support of.
You know, French, we got to cut to the chase on what matters here. You and I have talked about this before, but if you look at Razorback football, and you look at the schedule of Western Carolina, Kent State, BYU, LSU, finally a real game, LSU and Texas A&M later on. What in God's name is happening to college football, and what are you going to do in Congress to tell these people to get their act together?
Well, let me tell you, Tom, this is all about the money. And those schools love coming to Arkansas. They're going to make a lot of money, and I guess the Razorbacks are going to hopefully have 3 victories in a row. But college sports is now absolutely all about the money. And that's why Jonathan needs to come out here and watch some good SEC football and stop talking about, quote, European football, close quote.
French, I've told you, French, we're going to make it happen. It's a dream of mine. I want to make it happen. I want to go and watch college football in the South. I want to go and watch it.
To have someone like Congressman Hill tell us it's all about the money, I mean, that's the most shocking thing I've heard this year.
This year, French, is going to happen. Congressman, thank you. Congressman French Hill of Arkansas.
Great to be with you.
Atmosphere is awesome. Just absolutely fantastic. I think the closest thing in this country to European football.
As big a foreigner as I was when the first time I walked in to see Harry Kane play for the Tots, I woke up one morning in Boulder, Colorado, and there was a wall of red of Nebraska, and you sit there as an idiot East Coast kid, and Ralphie comes out in the field, and 30,000 people go mental, and the buffalo goes down the field like a real buffalo goes down, and you're like, and I've got my
marching band starts.
I got my screwdrivers or whatever they were serving me, and I'm like, you got to be kidding me! This is religion. For French Hill, it's religion.
I'm just so basic. I just started supporting Bama, which is, just like the most basic thing to do in college
LSU
football. If you don't know what you're
Razorbacks.
talking about, right?
Yeah, even I've heard of them.
I know.
Tells you everything you need to know.
PPI up next.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Day. In his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the country.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
Factory gate inflation, PPI data, just around the corner. We're seconds away from that. Going into it, your equity market, the scores look like this on the S&P 500, negative by 0.1%. Yields coming down just a little bit by a couple of basis points on a 10-year, 4.0861%. The 10-year, 30-year selling off yesterday, yields higher off the back of a softer than expected 30-year auction, following pretty decent demand at a 3-year and 10-year earlier on this week. The economic data drops. This is what we'll do. We'll look at the month-over-month stuff.
Where's McKee?
Just to look at the trend. You don't want me to do this?
No, please. I'm loving it. No, it's great.
I'm here just to break the news and then go. Mike McKee, it was his birthday yesterday.
What's he going British
He's
on
taking
us?
a day off. Here's the data. Tom, let's do this later.
Please.
0.3%, so slight upside surprise month on month.
Nailing it.
The PPI headline. The expectation in our survey, 0.2. If you strip out food and energy, that's also come in at 0.3%. So a slight upside surprise here. The previous number, slight revision there as well. But overall, just a little bit of an upside surprise on PPI data here. CPI yesterday came out bang in line. Looking at the equity market reaction to all of it, equity's a little bit softer, down by 0.2% on the S&P 500, and yields inflecting just a touch higher now. By not even a basis point, but we were down a little bit by a couple of basis points going into this print. Lisa, higher now by a single basis point a 10-year to, let's call it 4.11.
This pushes against the people who basically say a soft landing is in the books. And I've got to say, Andrew Hollenhorst coming up next is the best guest to talk to about this, given the fact that you are seeing some of the input prices, the fact that it's not just food and energy. It's also when you strip that out. That said, some of the downward revisions that are coming in do indicate that perhaps on a rolling basis, this is sort of going to average itself out. Ex-food and energy was revised downward 0.1% in the prior month versus the 0.1% gain. So maybe this is all going to be a wash in the end.
Knee-jerk reaction. We'll see if it sticks, but the price action looks like this. Equities down 0.25% on the S&P 500. Yields a little bit higher. Curve steepening just a touch. The 10-year up by a couple of basis points. Dollar stronger. The euro almost unchanged on the day now at about 109.88. I'm going to run because Tom doesn't want me here. Kathy Jones and Charles Schwab coming up in the next hour. Brian Levitt of Invesco, Jay Pulaski at TPW. I'm told Mike McKee is back next week.
You killed it. I remember, John, seriously, I remember like M1, M2, M3 was a big deal. John, there was a point 20, 30 years ago where the world stopped for PPI.
Would you like us to sit here and break the money supply data as well?
No, we don't have to, but all of a sudden maybe PPI matters. I don't know. I thought you did great there. It was like
thank you.
It was a toxic brew of inflation.
Not my first rodeo. I'll see you guys next week, okay?
Did another show to do.
Would you like to do the Open today?
No.
Would you like to do that?
No, I did it once. You know,
How did that work out?
It was a disaster.
Because I'm on my way out the door, Tom.
But, you know, I look at PPI. Do they have PPI in the United Kingdom? I'm just keeping him here as long as I can.
No kidding. He's literally going to walk off the set.
John Farrow, thank you so much. The Bramo Cam will capture him walking off set. On set right now is our interview of the day for those of you concerned about the persistency of inflation. Andrew Hollenhorst is chief U.S. economist at Citigroup and has been shockingly prescient about elevated inflation, not only in America, but for Citigroup worldwide as well. Andrew, I want to go back to yesterday's free-for-all on 1 year, 6 months, 3 months, 1 month annualized. John's beautiful job there on PPI. Seriously, the granularity of the data. Are we getting way too granular here, Andrew? Are we so desperate that we're just looking at every single tea leaf?
Well, I really think you have to do both here, Tom. And I would say for John, PPI is one of the hardest releases to read. You have a lot of different subcomponents, a lot of different core measures. And we look at all of ththose things. We look at those things in core CPI also, the super core. We're looking at various measures of underlying inflation, 1 month trends, 3 month trends. So you have to look at the details, but then you have to look back, step back, and look at where is the trajectory broadly in the economy. So looking at the details, there's some upside risk we're seeing if we look at inflation in August. We obviously have gasoline prices that are up. Airfares are down 20% since March. That's certainly not the experience I've had with airfares. So we think we're going to see those coming up in the official data. That's on the kind of details, the short-term movements month to month. But then you step back and you say, where are we going as an economy? It's an economy that's generating 2% plus growth. It's an economy with a very tight labor market. wage growth running around 5% by various different measures, that's not an economy that's going to bring inflation back down to 2%. So yeah, we're getting a couple months of softer inflation readings here. That's certainly going to look like a soft landing. I don't think that's where we're headed.
We were speaking with Vishy Turbatur of Morgan Stanley earlier, and he said that the bond market action this week was a head scratcher. Since you got softer than expected economic data, you did get confirmation, at least in the data that we're getting right now, of disinflation. Do you agree, or do you think that this makes perfect sense, that the more the Fed gets complacent, the more concerned people are about longer-term inflation?
Yeah, I think there is a way to make sense of the price action this week, Lisa, which is partly that this soft landing idea narrative and the softer inflation data that's come in was really well priced into the market. Speaking to investors ahead of the CPI release yesterday, it was hard to find anyone who really thought that this wasn't going to be a very soft print. So I think that was already in the price. So then what investors are looking at is some of those details, some of those trends in the labor market, the longer term trends in the economy. And exactly like you're saying, Lisa, if the Fed is going to be finishing up rate hikes and pretty much everyone thinks either they're done or maybe they're going to do another 25 basis points in November and be done, then we're looking at where does inflation go from here, and do Fed officials just need to keep policy rates higher for longer? I think that's a discussion that we're going to increasingly be hearing amongst Fed officials, is increasingly going to play out in the market, this idea that maybe just the neutral policy rate where policymakers need to leave Fed funds in the longer term is going to be higher.
How much do oil prices, do commodity prices feature into this? I was looking at a Mohamed El-Arian column yesterday saying there's an asterisk next to the disinflation that everybody was celebrating yesterday, and it has to do with oil prices heading toward their 7th weekly gain. Looking at food prices, which are starting to inflect higher, how much do these sort of affect the larger input prices, like the factory gauge ones that we just got?
Yeah, so I think the Fed really got helped out with lower inflation, with gasoline prices coming down, energy prices coming down, food prices that stopped rising as quickly. And we were saying at that time, Fed officials should be a little bit careful in terms of take credit for that downshift in inflation, because Fed policy doesn't really control oil prices or food prices. And now they may start experiencing the opposite scenario where you actually get some of these commodity prices moving higher, most notably energy prices. So that is something that Fed officials, economists tend to look through to the core measures. But, I mentioned airfares before. We're getting higher jet fuel prices. That's going to boost airfares. And that August inflation reading, we could get a month-on-month increase on the headline, something like 0.4, 0.5, 0.6% month on month. So that could really kind of change the narrative in terms of how the numbers are coming in.
Andrew, just a simple question. Are we beyond the pandemic? Are we back to conventional macroeconomic analysis?
So I think we can still use conventional macroeconomic analysis. And I think that's one way that we've been forecasting inflation and thinking about inflation staying higher for longer. The idea that tight labor markets do drive inflation over the medium term. So I think that framework of analysis has actually been a useful one throughout the pandemic and then this post-pandemic period. But the idea that the economy is going to kind of normalize back to where we were, let's say 2012 or 2013, I just really don't understand that analysis. A lot of people would have thought in 2013 things looked pretty different than where we were in 2005. So I'm not sure why there's this belief that we would go back there.
So this is the heart of the question. I'm going to get a little wonky here, folks. This is wrapped around John Williams' R-Start and all the theory mumbo jumbo that Dr. Hollenhorst is really quite good at. The school of thought out there, Andrew, is that we return to a quiescent R-Start, and then there's debate. I'm going to wrap it around what Olivier Blanchard has done, where there's a new higher R-Start set, or dare I say people debt worried, looking at an even ever higher R-Start. Where are you on this? How do you position R-Start out 3 and 5 years right now?
Yeah, I think we have to think about the possibility, at least, that R-Star is migrating higher. And if you take the famous Laubach-Williams model, which to your point, Tom, is full of complexities, and the idea is you're doing this so-called Bayesian update where you look at the economy and figure out where R-Star is. I mean, you can very simply, you can say essentially what that model is doing is saying, if growth comes in higher than we expect, if inflation comes in higher than we expect, then it must be the case that the neutral real interest rate is higher than we thought it was. Well, where has growth come in? Stronger than we expected. Where has inflation come in? Higher than we expected. So that model over time should start catching up to what we've seen in the data, that it looks like R-star is rising. I think we're going to hear about this at Jackson Hole. I think that really could be the interesting conversation that Powell brings up. Now, to your point, New York Fed President Williams, the father of the Laubach-Williams model, I don't think that he thinks that R-star has moved up yet. He's made comments to that effect. So Powell, I think, can't kind of completely break away from what Williams is talking about. But let's watch Jackson Hole at the end of this month. I think we're going to hear some discussion about the possibility, at least, that R-star is higher.
How long can the Fed hold rates around these levels, 5.25% to 5.5%, before it causes recession at a time where perhaps growth is still strong, but it's coming down?
Yeah, I think there are lags of monetary policy that will very slowly but surely slow down the economy. We see that in the Senior Loan Officer Opinion Survey, where you see banks that are still tightening lending standards. You think about many people right now have a mortgage at 3%, 3.5%. Mortgage rates for a 30-year fixed rate mortgage are 7% now. So over time, people will start slowly but surely resetting into those higher mortgages. But those effects that slow the economy work with a very long lag. You're not going to be very incentivized to sell your house now and go pick up a new house at a higher mortgage rate. So that will only happen if you have a life event. You change your job, your family size increases. So that does slow the economy, but it takes a long time. So Lisa, it could be quite a long period of higher for longer.
Andrew Hollenhorst, thank you so much. You'll lighten up the airways. We're getting all sorts of emails here on Andrew Hollenhorst appearing on our lack of disinflation. I just want to say in Bayesian theory, which I'm death on, full disclosure, it's very well understood that Steve Cohen in the 2023 Mets, they used a Bayesian approach. That's how that worked out.
Is that what you're going to call this? Is that what we're going to call the
Andrew's pushing my buttons because he knows
rebuilding.
I'm just death on a Bayesian approach in statistics.
We call that rebuilding, Tom.
Yeah, we will
rebuilding
see.
The Bayesian approach.
Right now, a little weakness to the tape here, a little fractional, but we'll take it. The Standard & Poor's 500 on down 0.3%.
We did get a lot of feedback from listening to Andrew Hollenhorst over there from Citigroup, partly because I gather he's gotten quite a bit of pushback. A lot of people are believing this disinflation narrative, and he's pushing back. He's saying, stop it. There's going to be a reacceleration. Take a look at, for example, airfares. And this point is salient, not just because I've been focused on it a lot, but, if you have higher jet fuel costs, what does that do to the price of airfares? Can it continue to disinflate or deflate outright?
That's one item. David Rosenberg, rather, is talking up here some optimism on disinflation. He's been in that camp for quite some time. I know he wrote about it. I didn't read it all, but he read it. He talked about it out of Toronto this morning. I'm going to go to where Claudia Sahm is. And she's really important in this discussion. And she's sort of set back by her iconic analysis of how you measure recession is being bandied about now like it's a mint. And the answer is, she's begging for some humility here. And I really want to emphasize this, that even Andrew Hollenhorst, out on a wing of inflation, has an immense humility over how he could possibly be wrong.
Yeah. You know what humility is? This is probably my favorite story of the week, is that Zoom called all of their employees back to the office and said, you can't work from home anymore. And they're ending their
It's amazing how
Wednesdays.
many different narratives, as you said this week, end up being about, okay, what are we going to do out of the pandemic about how we work and where we work?
I mean, all of these kinds of transitions, this is where we're kind of struggling to come up with the right model. And you think it's Bayesian? I think the Mets are going to, try.
I think it's mostly kids. They got used to this in the pandemic, and they're like, well, this is fun. Let's keep this going. We're going to keep it going to the data check futures at -7, Dow futures -16. The Dow is Bayesian. We do that for John Farrow. This is Bloomberg. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We are about 15 minutes away from getting that PPI report, a bit of a confusing report considering that it doesn't exactly confirm the disinflation narrative. However, pretty much a status quo. What we're seeing in markets was a little bit of softening initially on the heels of that. You see the S&P down about 0.3%. The biggest back-to-back weekly loss potentially on the S&P, Tom, going back to March. The first back-to-back weekly loss going back to May. Is it a pause? Is it something more substantial? It's definitely on the heels of that grind upward in yields. 10-year yields now, 4.14%.
I'm so glad you bring this up. It is a 4 standard deviation plus 2 standard deviation to -2 standard deviation move off of July 28th. And the answer is, okay, is pullback the correct phrase? I'm looking at Standard & Poor's 500, of course, and it's not a correction. That's for certain. Is it? I guess there's a little angst out there. I think we're addicted to up.
That's the key, is that we've been addicted to up. And so when it doesn't happen, it's notable in a year that has been very much in one direction, led by weakness in the NASDAQ. A couple of names that we've been watching throughout the morning, but I think is really important to kind of game out in terms of what the signal is going forward. Ford shares, GM shares on the week, lower by about 6%, give or take. Ford down by about 5.7%. General Motors down about 6.6%. How much are investment managers now looking around at where unions are looking for some sort of negotiations, where they could potentially gain power, where that could eat into margins the same kind of way that we saw in UPS time? And to me, this is one of the key stories as people look forward to where do those wages come out of that so many people are asking.
There's no question the labor discussion is front and center, and it's going to affect some. Now, public sector, it's clearly there. And then maybe it's a new debate back 15, 16 years. Does labor have a new power? I think that's a huge part of the discussion into next year. But also, it'll be about the state of business. And if they continue, I mean, if you have Mari Barra come on, I get upset about this, folks. CFOs, CEOs come on Bloomberg. They talk to us, they talk to Mr. Weston and the rest of it, and they go, we're great, we're minting money. And you're back there as labor going, hello. And I think that's by far and away the greatest emotion.
Well, and that's been basically the story, right? A lot of UAW and others have said, look, if you're getting these bonuses, you got to share some of that. At this point, though, do we start to see that kind of backtrack the past decade, 2 decades, where basically profits came out of the expense of revenue sharing with a lot of employers?
We got any other stocks today? Any retail?
Well, I was looking at Tesla in particular because they are down less than the others, and in part because they have less union ownership. Honestly, I've been looking also at just big tech and how much they've been selling off Apple.
I think Dana Tulsi did a great job on the retail mergers and luxury yesterday. I was really happy with our coverage on that. And you compare EBITDA ratios of the acquisition of Versace years ago, 22 times EBITDA with 9 times EBITDA now, and you can see how it's a value proposition versus perhaps the foolishness of years gone by.
Yeah.
We'll have to see that over the weekend. This is a joy. Manish Kabra is with SocGen, and of course they are acclaimed as founders of French derivative mathematics. He came out of the Bank of America, Merrill Lynch combined with work at Deloitte as well, and he's a first-order excellence in derivatives, the dynamics of the equity market, and we get a brief this morning. What do the tails look like, Manish, right now? Do you have a clarity at SocGen about the constructive risks on the right side or the agony Talebian risks on the left side of the tail?
Yeah, I think it's fair, rather than what we had, back in October last year, rather than we didn't have, those very extreme tails and, that centered, dispersion of the, option curve. Now, things have changed. Things have changed dramatically. And now what we have is, if anyone is looking for, more balanced, more, moderate volatility regime, and that's literally where we are at. And I would not say, or not carried away with thinking where the low vol, the low VIX, numbers are saying, as against when you start combining different elements on the option market, you find it's more moderate vol, rather than extreme low vol. So, and if I cut it, and cut the chase, and if anyone is looking for, upside, the right tail, one should still be looking for the US. US is the place to be, as against, when we watch Eurostoxx 50, it's a better place to watch for the left tail. So differentiated nuances, things have changed though since October last year.
Decades ago, with Paul Wilmot's leadership at Imperial College, he put out a magazine on quantitative finance that was a Bible. We all read it cover to cover every 6-8 weeks whenever it came out. And one of the great hallmarks of what Paul Wilmot said is find out where the bet is. Where's the bet right now in the summer of 2023? Where's the extensive money being placed that sometimes can be wrong?
Yeah, at most of the money that we have seen, it's, it's still into NASDAQ, it's still into different form of AI, it's still into technology. And then that's literally where all the excitement has taken place throughout this year. And then if I look at, where S&P is, I think when we split micro versus macro signals, it's very clear the micro signals are very positive, whether it's AI-driven EPS, whether it's, industrial profit margins at all-time high. And then one of the very differentiated points we have raised at SocGen is, the current Fed cycle is actually helping the top 10% of S&P 500 companies, which is, the top 10% of stocks, they're cash rich. They're making interest income rather than interest and expense at this point. All of that, what it does, it's creating extra micro-based, micro signal-based earnings, earnings-driven signals where earnings volatility goes lower, and that drives a lot of the equity volatility as well. So we are quite positive on the, micro front. We find, out of the 3 points that I flagged, at least one of them, which is, the U.S. fiscal, the U.S. industrial policy, the U.S. Inflation Reduction Act, as in literally all of those. And I would say U.S. has a 5-year industrial policy as of now.
Manish, you just recently raised your S&P 500 target to 4,300, which is still significantly below where we are right now, which means a downdraft by year end. I'm wondering from your vantage point whether you would see anything or what you could see to raise that target further.
And then our take is, and then we come up with quarterly outlooks and quarterly profiles, and then we think S&P goes to, 4750 before we see all the negative elements in terms of, as you mentioned, the labor cost, the union cost on corporate margins, the credit cost. As in we are seeing, we are expecting, as in half of the Russell 2000, the small companies refinancing, will happen within 2 years. As in it started this year, it gets extended next year. So, and then my hunch is, I think we are very bullish on the micro front, but we are not, bullish on the macro front, which I would say, that's literally the reason why in asset allocation, we are neutral stocks, we are neutral US equities. And I think that's the right call to do, just when, there's a big fight between micro versus macro.
Right. Manish, got to leave it there. Manish Kabra, thank you so much with SocGen this morning here on the Dynamics. Get the teeter-totter, and he's sitting right in the middle with a balanced portfolio. Charlotte Hughes Morgan, Bloomberg reports for Bramo, for the benefit of Bramo, This is the heart of it. I'll read the headline verbatim because Brammo helped write the story. Amazon cracks down on employees who stay away from the office. Amazon expects U.S. workers 3 days a week. Firms from Zoom to BlackRock are demanding Brammo more on-site work.
This was an amazing story because they also evidently accidentally sent out reprimands to people saying, you know, you have not been to the office at least 3 days a week for the past number of weeks. And then they said, well, we have, and they came back, whatever. It shows the tension right now. And Amazon shirking their duties. Well, Amazon has been trying to bring people back to the office. There were picket lines for people who did not want to go back to the office. Amazon now coming out with a more strategic way of cracking down. You heard Google come out and say that they're going to evaluate workers based on their in-office attendance. There's a real push. Get back to the office, and workers are like, no way.
Do you think it's generational? Is it like Bitcoin where people of a certain ilk are like, no, and the younger kids say Bitcoin's legit? Is it generational?
You mean like
3
the
days a
Instagram
week?
generation that people basically wanted to travel?
No, the young,
I think that, I think it's a lot more complicated than that because I think that you have people who want to learn and who are coming into professions. I don't necessarily think that. I do think that there is this feeling if you create a lifestyle that you think you can work from home and then you've got to go back to the office. Are you trying to send me home?
Well, no, she was in her Paris flat through the pandemic. Lisa was working from home, and, you know, John and I are in New York slogging away, and she's in Paris with the trees and the boulevard out front and all that. Thank you for your attendance this week on radio and television. At 2 p.m., the stamp collector William Gross will make an appearance. Bill Gross on Mexican Carry. Stay with us. This is Bloomberg. The markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, you know, several years from now.
So what rules would you put in place and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, you know, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting and then be the one who says where that data goes.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Down on the session, down on the week. Live from New York City this morning. Good morning, good morning. Your equity market's softer here. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Fed officials insisting there's more work to do. The president taking digs at China's economy as a new era of labor power puts Detroit on notice. We begin with the big issue. Too early for a victory lap.
There is some fear of a reacceleration.
Reacceleration in inflation. I see more inflation as we head into the back half of the year.
The second half of the year. The end of the year and sometime next year.
In 2024. Timing is always difficult.
This is going to be a roller coaster.
Inflation is going to have a hard time hitting its 2% target.
We got a long ways to go before we get to 2%.
The economy is growing above trend.
You really need to see signs of broader economic moderation.
I don't think the Fed has done enough.
We may have another rate hike. The door's open for a hike in November.
The Fed is kind of enamored with this soft landing view.
The Fed could screw this up.
There is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up.
Joining us now to discuss Invesco's Brian Levitt, Kathy Jones of Charles Schwab. Kathy, straight to you. Is there reason to believe this Fed is done?
Yeah, I think there's a lot of reasons to believe the Fed is done. Despite the worries about reacceleration in inflation, we're just not seeing very much of that. Now we've got the energy issue, but where is that reacceleration going to come from? We have moderating growth. We have the unemployment, is low, but starting to edge up. Wage increases are starting to moderate. You can't get it through the credit channel because credit is tight and tightening. And globally, we've got, some real weakness coming out of China and Europe. So I'm wondering where this big reacceleration in inflation is going to come from outside of perhaps energy.
So here's the challenge. Comes from Larry McDonald and on Twitter moments ago. This is what he had to say. U.S. government spending up 10% year over year. Labor unions carrying the most power in decades, a resilient U.S. economy, and the Saudi kingdom aggressively cutting oil production into record demand. He says all of that not deflationary. Brian, what do you say?
Well, I'd start with the energy comments. I mean, the energy will be a tax on the U.S. consumer, and so part of what we've been waiting to see in all of this is for the consumer to moderate. So that would be one thing. I agree with really everything that Kathy had to say. It's an economy that is going to moderate in the coming quarters. We still haven't seen the lagged effects of all this policy tightening, and to think that this time is significantly different, I would disagree. The way these things almost always play out is, the Fed tightens significantly, inflation peaks and comes down, the markets rally, and people don't believe that inflation is really done. And typically what you find is the banks start to tighten the lending standards, economy slows more, and the inflation story becomes completely passé. So that's where I am. I know on a basis effect, you're going to have some pickup on a year-over-year basis just because of some months rolling off, but that's not what I'm focused on. I want to see the month over month, and the last report was 0.2%. You annualize that, you're very much within the Fed's comfort zone. So that's what I'll be watching, and I think that this is an overblown risk.
A tiny upside surprise on PPI 33 minutes ago. Brian, this is what Neil Dutta of Renmax got to say. I think the bigger issue for the market is that it sees core producer prices bottoming. We know freight rates are bottoming, and we know that oil prices are climbing. He goes on to say, risks are building, that the Fed has more work to do. One question, Brian, that Neil has asked, and I'll ask that question of you, how is 3.5% unemployment consistent with inflation returning to 2%? What's the answer to that, Brian?
Well, it's a lagging indicator. And, we've always talked about how long it takes for a policy to work its way through the system. And quite frankly, it may just be going a little bit slower right now because we all locked in fixed rates, all of us, including homeowners and businesses, and push maturities well out in the future. But it will continue. It will ultimately bite. And you've seen some signs of some weakness in the job market, or weakening in the job market. So this will play out. I think it's I think it's a challenge to say it's different this time. I think in every cycle, we you can go back to the early 1980s and not be convinced that inflation was broken, and ultimately it was. So you'll see the unemployment rate tick up as the economy rolls over next year, and that'll set the backdrop, in my opinion, for the Federal Reserve to be with a full shift in stance in 2024.
Kathy, do you agree with that?
Yeah, I agree with Brian. I do think the Fed will be focused mostly on the growth numbers going forward. I think they're pretty satisfied that when you look at the numbers, they've pretty much achieved their inflation target, and it will continue to roll over. I think what they really are looking at, though, are the growth numbers to see if they can maintain this low inflation that's coming through. So that's the risk to Fed policy going forward. I think that they're still very much focused on coincident indicators, maybe lagging indicators instead of leading indicators, and those are pointing to still some firmness in the economy. But I don't think that they'll be hiking again. I think that in 2024, to some point, we will see some rate cuts.
Stocks rolling over this morning. We're down by 0.3% on the S&P 500. Treasuries lower as well. Yields are higher on a 10-year by 3 basis points. On a 2-year by 4.88 on a 2-year. CPI out yesterday, PPI this morning. Let's put it together and catch up with Bloomberg's Ed Harrison. Ed, wonderful to catch up with you, buddy, as always. What's the takeaway for you from CPI yesterday, PPI this morning?
I think the takeaway is that all of the disinflation is bottoming, and we have to look to services in the core to see whether or not we're going to get to 2% anytime soon. So there is work to be done if the Fed wants to go to 2%. There's less work to be done potentially if they don't want to go to 2%.
Ed, we've got two guests here, Brian and Kathy, talking up the end of the hiking cycle and the potential for rate cuts in early 2024. What's the pushback, Ed, against that?
Yeah, I think the pushback is that we're not going to get to 2% anytime soon on core services. And so the question is how hawkish is the Fed given the data that we've seen come out? And I think that there's a cohort of people at the Fed who are saying that, we actually want to hike maybe 1 or 2 more times. We saw Mary Daly saying that there's still work to be done just earlier this week. And, she's considered to be neutral to dovish. And then once we get to that level, they've said consistently, at least for a year, that they're not going to cut. And you'd have to see the labor market back up considerably in order for them to actually cut. So it's more likely that they're going to hike and hold than it is that they're going to hold and cut.
Ed Harrison on the latest. Ed, wonderful to catch up with you out of DC on CPI yesterday and PPI this morning. Ed mentioned Mary Daly of the San Francisco Fed. This is what she said to Yahoo Finance. It is not a data point that says victory is ours. Speaking of CPI out yesterday, there's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% inflation target. Brian, you heard what Ed just said then. If you're looking for cuts in early 2024, where do you anticipate the labor market is at that point?
Well, I would say the market's telling us more out towards like mid-2024. So my view is that the economy starts to slow in 2024, and then you'll see the Fed pivot. The good news is that, the labor market doesn't have to break significantly. We had a period where we were short of workers, and so businesses are unlikely to be, removing workers significantly, and that's how you start to get a better feel in this than what you've had in past cycles. Investors are so used to in 08 or 2020, it doesn't have to be as catastrophic at that. But, a lot of talk about the core services and, a lot of talk about service inflation and things that, I'm not hearing mentioned is how soft the apartment rental market is. You've seen a collapse in money supply. You have businesses that have rebuilt inventory pretty significantly on the goods side. So all of this feels disinflationary to me. And if you look at what the bond market is telling us, at least in the break-evens, there's not a lot of concern in the bond market that the Fed has lost control of inflation or that inflation is not returning to the 2% comfort zone. So I don't think it has to be 2. I think that we're 2 to 3% comfort zone with an economy rolling over, has the Federal Reserve proceeding with caution.
So, Brian, you and Kathy are both on the same page here. This Fed might be done. Rate cuts might be coming early next year. There's a difference, though, in the market call. I've been going through the notes overnight. Kathy believes this is the moment for duration, not for credit risk. Brian, you believe this is the moment for cyclicals in the equity market. So, Brian, you've got to explain that one. If you're expecting a Fed to be cutting because the economy's not doing so well and inflation's coming down, why do I want to buy cyclicals right now?
Well, there's a moment in time where the market is gonna have a nice trade over the course of this year. So our view is that you're going to continue to move higher this year. The economy is going to remain resilient, and we're going to get better comments out of the Fed, more of a sign of a shift that that the end of the tightening is here. So that's more of a risk-on backdrop between now and the end of the year, more of a cyclical feel. The economy rolls over. Next year, you'll probably get more of a contraction, more of a defensive type of trade. But ultimately, if we're right and the Federal Reserve starts to back off the tightening stance, well, then that's the beginning of the new cycle. And the market will start to look ahead to that. And so tactically, you may be risk on to hear the end of the year, maybe give back a little that as the economy rolls over. But if you don't want to be so tactical and you're thinking about how new cycles emerge, well, they tend to emerge with the Federal Reserve backing off the tightening cycle and ultimately easing, and that's when you want to be exposed to risk assets and more exposed to credit and more exposed to early cyclicals.
Kathy, we teed you up here. Why is now the moment for the opposite, duration over credit risk?
Yeah, our concern is in the credit markets that we're still in a tightening mode. Not only is the Fed still, holding rates at very high real levels, but they're shrinking the balance sheet. And it's not really reflected very well in credit spreads. The risk, particularly in, say, the high yield market, at under 400 over is just not giving you a lot of reward for taking the risk into a slowing economy. And we know that a lot of the borrowers have termed out their debt and the maturity wall is still a year away, but that's not really a steamroller we want to step in front of in a big way. We'd rather get more risk premium if we're going to take if we can take that risk. And it's just not really reflected there. And so given all the tightening that's in the pipeline, given the lending problems that we're seeing in the banking sector, our concern is the credit markets just aren't giving you enough on a risk-reward basis.
Kathy, Brian, stick with us. Slight tweak from Bank of America and a team led by Mike Gapin. The story just dropped in my inbox. Then note, the title, When Doves Fly. The first few bullet points, I'll share them with you. We tweak our Fed call, shifting the last hike from September, pushing it out to November. The main drivers of the change are the benign July CPI report and dovish Fed speak. I think they're leaning towards the Williams speak more than maybe the daily speak. Upside risk to food and energy prices and a resilient economy keep the last hike on the table. But Gapin and the team saying it's a close call. The latest from Bank of America just moments ago. Let's get you some movers going into the opening bell. Here's Abby.
Big tech stocks, John, are also saying it's a close call because we, of course, do have yields up a little bit today on that PPI, and big tech is down. In fact, the NASDAQ 100, if its current losses hold, will fall 5% on the week or thereabouts, so a pretty rough week, a second down week in a row. NVIDIA yet to report, down 1.5%. Will the AI hype show up in their numbers? Tesla down 1.2% as a China competitor is cutting prices, and then Apple, not down a lot, John, but down 0.3%. If this loss holds, it will be an 8th out of 9 days, the worst stretch since last year, of course, on slowing growth concerns. Plus, as yields are higher, of course, the valuation for these big tech stocks really comes into question.
Abby, thank you. More from Abby around the opening bell. Coming up, China's economy showing further signs of weakening.
I think the China stimulus narrative is one that the markets have really loved and embraced, and we're getting a bit of a reality check on that.
China's new loans plunging to the lowest level since 2009. That conversation up next.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think the China stimulus narrative is one that the markets have really loved and embraced, and we're getting a bit of a reality check on that. As it relates to commodity prices, all of this news of stimulus has certainly pushed them up, pushed inflation expectations higher, and that's become a big problem for the Fed here, who certainly has not yet claimed victory on inflation.
Emily Rowland of John Hancock on the implications of a weaker Chinese economy. More cracks emerging, with new loans from Chinese banks in July falling to the lowest level since 2009. President Biden adding insult to injury, calling China a ticking time bomb, and adding, quote, "That's not good, because when bad folks have problems, they do bad things." Let's get to team coverage now with Bloomberg's Katie Lyons and Tom Orlik out of Washington. Katie, what did the president mean by that?
Well, he was essentially poking at China's economy, John, but in doing so, he also said a few things that are just simply factually inaccurate. He was talking about how they have a higher number of people of retirement age than working age. That statement not only is untrue, it's off by hundreds of millions of people. He also said China has gone from growing 8% a year to 2%. China grew 5.5% in the first half. So he was saying some things that were untrue, but definitely sharp criticism of China's economy at a time in which the economic conversation around China for Beijing is likely highly sensitive. I know Tom will run through more on what is going on in the economy and some of the fragilities of it, but it could be poking the bear a little bit here, especially at a time in which President Biden and his administration are trying to stabilize ties with Beijing. We have seen something like this happen before, John. If you recall back in June, also at a donor event, Biden referred to Chinese President Xi Jinping as a dictator in the almost immediate aftermath of Secretary of State Antony Blinken returning from a trip to Beijing, attempting to normalize relations. Of course, since then, we have seen other officials traveling to Beijing. U.S. Treasury Secretary Janet Yellen made a trip, as did climate envoy John Kerry. We're expecting Commerce Secretary Gina Raimondo to do the same, but this still could be disruptive in this relationship and could make it more difficult, perhaps, the proposition for President Biden to meet in person with Xi Jinping this fall, considering not only he is making remarks like a ticking time bomb, but also the U.S. is taking active action to restrict China's advancement of certain technologies, like the executive order on outbound investment the president signed earlier this week.
Audience matters. It was two donors, and you can only imagine, draw the conclusion that this is what donors want to hear right now from American politicians. Yeah. Tom, on Wall Street, we're focused on the data. The information we're getting from the economy this week, not great. Tom, just how bad things are they?
So first of all, Jonathan, I've just got to pick up on one comment from Kaylee. As this is China, we're not actually poking the bear in general. We're specifically poking the panda. But coming to the data, I think Biden was wrong on the specifics of the numbers he used, but in spirit, he hit the right point. There are some serious problems in China right now. We're having defaults by some really big property developers. Household wealth is tied up in property. Property is the biggest driver of growth in the economy. And so, of course, when property goes down, confidence slumps, and we're now seeing that playing out in a big hit to the credit data. Now, keep in mind here that credit data is bumpy, volatile, seasonal, so we'll want to look at a few more months before we draw a firm conclusion. But clearly, a really, really big miss on the loan data for July is not what China's policymakers want to see right now. Our expectation is that the response, it's not going to be shock and awe stimulus. They don't have the firepower to do that. But we expect more with a steady drumbeat of pro-growth measures in the months ahead.
Tom Orlick, Kelly Lyons, two of the very best down in Washington, D.C. To the both of you, thank you. Brian Levitt, Kathy Jones, back with us for a final word on this. Kathy, when you see data like that, like the data we had out of China this morning, what did you think?
Yeah, it's surprisingly weak. I mean, we knew it was going to be soft, but surprisingly weak. And it tells me that we're on a trajectory here globally that you really aren't going to get a lot of stimulus, a lot of economic impulse coming out of the global economy anytime soon. So that, combined with what we've seen out of Europe recently, tells us that we're just in a very slow growth world for the time being.
Kathy, typically if we woke up, let's say 8 years ago, to data like this in China, new loan growth at the lowest since 2009 from Chinese banks, a property developer trading like a penny stock, it is a penny stock over in Hong Kong. Brian, these were all things that used to drive massive bond market rallies, big commodity market sell-offs. Brian, why do we feel a little bit more comfortable with this drip feed of negative data out of the world's second largest economy? Where does that comfort come from?
Yeah, I mean, you've seen a pretty resilient U.S. economy, so there's some comfort in the resiliency of the U.S. economy and the lack of leverage in the U.S. economy and the general strength that's been persisted by the U.S. consumer. But I agree with Kathy on this. I mean, this goes back to the point that we were discussing earlier, is that there's not a big catalyst for significant economic growth in the world. And so this move of rates higher, this concern that inflation persists and the Fed's going to have to keep tightening, I think is overstated. It's looking backward. And, you know, the Fed has tightened a lot. China has done some pretty tough regulatory measures a couple of years ago, tough COVID measures last year. So that economy is struggling. And of course, Europe has its challenges. So you point to all of that. It's, we see rates going up in the U.S. today. I just don't think it's sustainable. I think you'll see rates back down, and that'll start to lead to more risk taking again in the United States, because the U.S. becomes a place where growth is reasonable and the Federal Reserve can start to pivot.
Brian, Kathy, the two of you, thank you. Have a good weekend. It's good to catch up. The opening bell about 7 or 8 minutes away. Equity futures lower here by 1/3 of 1%. Brian referenced that bond market sell-off. A bit softer this morning. The Treasury market down. Yields up by 5 basis points on a 2-year. 4.89 on a 10-year here by 3 or 4 basis points to about 4.14. I believe this is the 4th week of 10-year yields climbing higher in the Treasury market. Coming up, the morning calls, and later we'll catch up with TPW's Jay Pulosky around the opening bell. Your opening bell, 7 minutes away.
Of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local to the local countries that they are operating in. So you need to be global and local at the same time.
5 minutes away from the opening bow. Stocks lower here across the board on the S&P, on the Nasdaq, on a Russell as well. That's the price action. Here's some morning calls. First up, Wolf Research downgrading Stanley Black & Decker to underperform, pointing to margin headwinds and an unattractive valuation. That stock is down by 1.5% to 93.86. Your second call from Citi, opening an upside catalyst watch on Cisco, whatever that means, expecting strong enterprise demand to fuel better than estimated results next week. Their stock is just about unchanged at 53.35. And your third and final call this morning from Redburn, raising its Amazon price target up to $230, expecting shares to rally as revenue growth starts accelerating. That stock is negative by 0.8%. The retailers come next week, remember. That's going to be the earnings story for Wednesday and Thursday. Target on Wednesday, I believe, Walmart next Thursday. Coming up on this program today, a new era of Labour power putting Detroit on notice. We'll catch up with Jay Poloski of TPW. That opening bell just around the corner.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
First international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the country.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
24 seconds away from the opening bell here, down across the board. On the NASDAQ, we're down by 0.75% on the session. On the week, we're lower as well. On the week, I've had to check this stat about 5 different times already. We are poised for the first back-to-back weekly loss on the NASDAQ 100 of the year so far. That's your opening bell. Switch to the board and get to the bond market. Yield shaping up as follows on a 10-year higher by 4 or 5 basis points. PPI with the softest of upside surprise is enough to generate a lift in yields here, particularly following the weakness we saw yesterday afternoon in the Treasury market following that soft 30-year auction. 3-year was okay, 10-year was decent, the 30-year supply didn't go as well. Yields up and away. In the FX market, the dollar stronger off the back of that PPI report. The euro negative by 0.15%, 109.65, and crude just a touch lower here by 11 cents. We're down by 1/10 of 1% to $82.71. About 30 seconds into the session, your equity market is lower by 0.5% on the S&P, down by about 0.8%. 0.75% lower on the NASDAQ. One stock to watch at the open, Virgin Galactic. Shares moving higher after announcing plans for the next space tourism mission. The launch is on track for 1 month from now. Abby has more. Hey, Abby.
Hey, John. And folks have been waiting for this possibility for almost 2 decades. This company, of course, was founded in 2004 and talked about these space tourist flights happening as early as 2007. There's been a lot of incidents in between, including one tragic crash back in 2014. But we did have a successful launch, and we had space tourists going to the edge of space yesterday. Now, it's interesting. The stock over the last 8 days into today down, the longest losing streak since 2021. Today, up a measly 0.6%. You would think that on this sort of a milestone that the stock would be up much more. The stock, in fact, is down 94% from its 2021 peak. It has everything to do with the numbers. There's minuscule revenue that they are making. There's a huge backlog, I believe 800 folks who want to fly into space. So they really have their work cut out for them. Deeply unprofitable, an 18.5% short interest. So yes, we had this great milestone yesterday for space, but they're also competing against Jeff Bezos's Blue Origin. Again, this company really has its work cut out for them.
Who goes highest, Abby? Do they actually go to space or not?
You know, the edge of space, I'm not sure if I count that as space, but I'm also not an expert on it, so.
Kind of there. Abby, thank you. Turning to financials, UBS ending its $10 billion backstop agreement with the Swiss government to cover potential losses from its takeover of Credit Suisse. The CEO, Sergio Ermotti, calling it, quote, a testimony to the strength of UBS. Katie has the story. Hey, Katie.
Hey, John. Yeah, UBS top brass taking a little bit of a victory lap this morning after voluntarily terminating that loss protection agreement with the Swiss government. That decision came after stress testing a portfolio of Credit Suisse non-core assets. UBS also said that it will terminate a liquidity backstop with the Swiss National Bank of up to 100 billion francs. Now, these support measures, of course, had smoothed over that shotgun wedding between UBS and Credit Suisse, of course, officiated by the Swiss government. And taken together, the end of these support measures suggests that not only is the integration of these two banks on track, but that Credit Suisse's assets might be less troublesome than initially thought. Not everyone is thrilled about this. John, Bloomberg's News reporting in the last hour or so that the Credit Suisse AT1 bondholders who were wiped out are unhappy with these moves. This is according to people familiar, arguing that basically the end of these backstops means that the write-down of those AT1s was unnecessary. We'll see how that develops.
Katie, thank you for that. They've been unhappy for the last 5 months, and for good reason. Another media company reporting results, News Corp, posting a 75% drop in annual profits. The CEO hinting at an AI-driven future, saying, quote, we believe generative AI presents a remarkable opportunity to create a new stream of revenues while allowing us to reduce costs across the business. Simone has more. Hey, Simone.
Hey, John. Yeah, traders trying to figure out exactly what's going on here. Our shares were down a little bit in the pre-market. Now they're in the green. Revenue missing estimates. Revenue $2.43 billion for the fourth quarter. We heard that yesterday, down 9% year on year. Analysts were looking for something closer to 2.5 and sliding across all different segments. But if you were looking for something positive, the message was clearly there in the digital side. Digital accounting for over 50% of News Corp revenue for the full year. For the very first time, Dow Jones also seeing its highest profit ever. BI says this is a bright spot, accounting for 22% of revenue during the year. We heard that mention of generative AI. The one place that's not so positive, though, the book publishing segment, Bloomberg Intelligence says that's in free fall The company also saying Simon & Schuster just wasn't a good enough deal for them, and that's why they didn't push in there, John.
Simone, thank you. That stock just inching a little bit higher, trying to bounce. Let's turn to autos. This, for me, the story of the last 24 hours within the equity market. GM and Ford looking to avoid a fourth day of losses amid growing concerns that union negotiations could send their labor costs absolutely soaring. Analysts at Morningstar warning the stocks could be in the penalty box for a while. David Welch out of Detroit joins us now. David, just run us through what this union boss is asking for.
He's sort of given the automakers a laundry list of just about everything the union could ask for. He wants to claw back anything and everything that union auto workers made concessions over since 2007. Recall back then, Nation and the car companies heading into the financial crisis. General Motors and Chrysler eventually went bankrupt, and they agreed to lower wages for starting workers. They gave up defined benefit pensions in favor of 401k for new hires. Workers didn't get a raise for a very long time, even those who were at the top $32 an hour wage. There were other things like cost of living allowances. All that stuff went away. So he wants cost of living allowance, some sort of inflation protection back. He wants raises for workers, and I think the companies are very willing to give in on that. The things that they won't touch, that the union has asked for, and these are very big ticket items, and arguably what pushed General Motors into bankruptcy, were retiree health care guarantees and a defined benefit pension plan. Both of those things were tens of billions of dollars in liabilities that GM couldn't afford at the time they did go bankrupt. Same thing with Chrysler. And the unions asked for that. I'm not sure if the union believes they'll get that. I think pay and reducing the number of workers who are on this kind of sort of entry-level pay scale, I think eliminating that will go a long way. And also securing the compensation for battery plant workers. That's another thing the union wants. I think those will be the issues with the auto worker or the automakers can do something on. But I think the retiree stuff, I don't see them touching and going back to the days when they have those massive liabilities.
David, do you sense that on the other side of town, on the West Coast, you've got Tesla just sitting there smiling, watching this play out in Detroit?
Yeah, and I think Tesla's probably smiling. I think probably Toyota and the Japanese and European automakers who are here and don't have union plants are looking at this and saying, okay, my competitors' labor costs are going to go up one way or the other. And that's really the overhang on the stock is even if you don't have a big strike, and I think we probably will, but even if you don't have a big strike and even if the union doesn't get these retiree benefits, you're still looking at a more expensive labor contract. It is one the companies can afford because wages just aren't that huge a part of the cost of a vehicle these days, but it's going to be an expensive contract. And if you're looking at companies that don't have a lot of growth and are looking at lower profits, lower prices on electric vehicles right now, this doesn't help them.
What a moment for that industry. David, thank you. TPW Advisory's Jay Pawlowski weighing in on this race. Here's a quote for you. We're going to have a great conversation in a moment. The traditional winners of the auto race, the Europeans and Japanese, have fallen behind the US and China in the EV race, with potentially dramatic implications for their industrial bases. Jay Pawlowski joins us now for more. Jay, wonderful to catch up with you, mate. We're going to do something different and focus on this because I know that you and the team over at TPW are laser focused on this one issue. What do you make of these labor negotiations and how do they shape that war in that tripolar world that you often talk about between China, Europe, and the US in this industry?
Well, I think the auto industry, John, is kind of at the forefront of what we see as an age of competition, right? That's what we wrote about in our monthly last week. And in the EV space is really the sharp tip of the spear. And that's where the Chinese have taken a leadership role, right, in terms of almost the entire EV, battery, and renewable space. And so Tesla in the U.S. is the U.S. main competitor. GM and Ford are lagging far behind. And then you have the Europeans and the Japanese who have really missed the transition so far from internal combustion to electric battery mobility. And that's really the forefront. And that's kind of the point, John, as we look at the future, the next 3 to 5 years, we see an age of competition between our three main regions of Europe, Asia, and the Americas in an AI age, which means the speed of things are picking up. And what we think this implies for investors, because we always have to bring it back to the markets, obviously, is that we're going to have a shift, and we're just at the beginning of it, from a focus on monetary policy with the Fed and ECB, et cetera, to fiscal policy and a manufacturing revival. And we think the surprise near term for investors in the second half of this year and into 2024 is going to be just that, a manufacturing recovery and a CapEx boom that's going to take place over the next 3 to 5 years, driven by this need to compete. All three regions are highly motivated to compete because you're talking about climate, you're talking about AI. There's not really an excuse for not competing in these spaces.
Jay, how did the likes of GM and Ford compete when they face demands like these? 46% wage increases, restoration of traditional pensions, cost of living increases, shorter work week, better retiree benefits, all things that workers are entitled to ask in a labour market like this one. But Jay, given the argument that you're having, how on earth do those companies compete with what is happening elsewhere?
Well, I think, John, I mean, it's not just, GM and Ford. We have Tesla in the United States, right? And so that's our ace in the hole. The Japanese, the Germans, they don't have anything. So they don't, Toyota, Mitsubishi, it doesn't really matter. And the race is sharpening where in China, BYD and others are basically eating the lunch of the European and Japanese. The Japanese are shutting down production in China, and BYD and others are now making inroads into Europe. And here's the good news for the U.S. is that we have a tariff set up in the Inflation Reduction Act limits producers to producing in the United States if they want subsidies. So how GM and Ford compete is really up to them, right? And so that's an issue for the companies and for the leadership and for the unions to kind of figure out. But from a big picture, tripolar world perspective, the U.S. is in decent shape. And what's kind of interesting when we think about this competition is that the U.S. leads in AI and China leads in climate. And then the second big takeaway we had is that the U.S. is adopting Chinese policy, state-driven, new industrial policy, right? Top-down, public-private sector cooperation, while the Chinese are adopting the U.S. strategy of trying to drive growth through consumer demand and consumption. So the two of the three main players are switching clothes, so to speak, and then you have the Europeans who have sat on the sidelines, content to be rule makers and regulators, and they're realizing that they can't afford to sit in that position. And so just in the last 2 weeks, as an example, switching gears a bit, you've had Germany announce 2 semi-fab plants being set up in Germany as Europe starts to get in the game, because the other side of the AI is obviously the semi side of things, as well as the EV and climate side.
So, Jay, what I hear from you, just to make it really simple, just the headline here, the US is winning at EVs, thank you, Tesla. China's winning at climate. We know they're producing a load of solar panels and they have the goods to keep on going. Europe's winning at nothing. So, Jay, let's talk about investment opportunities. Where are they? What are they right now?
Yeah, I mean, John, we've been talking about rotation. We wrote about rotation 3 months ago, titled our piece Rotation from Big Tech to Cyclicals in the U.S. That's worked out really, really well. You just talked about NASDAQ being down 2 weeks in a row. We continue to focus on what we're now calling a rolling rotation. And so that rolling rotation, we're going from rate hikes to rate cuts led by the emerging markets. We're going from monetary policy to fiscal policy, focus on manufacturing recovery. So we're really focused on 2 specific areas right now. We continue to be overweight equities, underweight bonds, and overweight commodities. What we like at the moment and where we're focusing our model portfolio work is in emerging markets, both in China. We think China is set up to recover nicely in the second half, definitely counter consensus. We're just added to Chinese tech here in the last week or two. And then in the commodity space, where we're sharpening our edge on energy, as well as in industrial metals, as well as in uranium on the climate side. So we have specific areas that have lagged. Commodities are just breaking out. We think there's significant upside if we're right in our manufacturing, competition, CapEx boom, big upside for EM, big upside for commodities, John.
Jay, got to squeeze it in. You went there with a massive counter-consensus call on China, given the news we've had this week. Deflation, you've seen the loan data. For people just tuning in, get this loan data out of China. Chinese banks extending the smallest amount of monthly loans since 2009 in the month of July. Jay, where's that demand going to come from? Where's that stimulus going to kick in? What does it look like? Where does that constructive view come from for you?
Yeah, no, you're absolutely right, John. It is counter-consensus. The bashing of China is just off the charts, right? It's basically like, you know our view was that no recession. Our view has been constructive on risk since last year. This is the same thing with China right now. So China's just replaced the recession call as, bash China. It's the easy thing to do. Look, China is suffering from a lack of consumer confidence. It's very clear. Savings are skyrocketing. Same thing as in the U.S. 6 months ago. Money market funds. Everybody wanted to talk about them. Same is happening in China. So we need to see some more constructive policies out of China. One reason why we like tech is that the government has moved away from the tech bashing of the last couple of years. They realize now they're in an AI fight. They have to support their tech space, same in the U.S. So we expect to see continued policy support, not a big bang, not a huge stimulus, because that game is not going to happen in China. Oh, I just lost my lights. So there you go from China. They shut the lights off when you talk bullish on China, John.
You're not allowed, Jay. It's banned. Jay Pawlowski at TVW. Jay, go and enjoy your weekend. Thank you. Giving us all something to think about there. About 16 minutes into the session, we're down about 0.5% on the S&P 500. On the Nasdaq, we're down by 0.9%. The PPI data about an hour and 15 minutes ago will be blamed for the move, no doubt. Whether you think that should be blamed for the move is up to you. In the bond market, Treasuries down, yields are higher by 6 basis points on a 2-year, 490 on a 2-year. The 10-year getting back up to 414, up 4 basis points there as well on the 10-year. Remember, in the last 24 hours, just a softer issue at the long end in a 30-year auction yesterday, pushing Treasuries down and yields up. And that move this morning continues, and encouraged by maybe that small, mild upside surprise on PPI. Up next, we're going to wrap up the week. We'll catch up with Mike McKee as Fed officials insist there's more work to do.
The Federal Reserve has a dual mandate from Congress. The first is to foster stable prices. And this is why we have been working hard in recent months to reduce inflation, which has been too high, and bring it back down to our target of 2%.
The team coverage here at Bloomberg continues.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth. And countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
It's also consistent with what we believe will be happening, which is that inflation will gradually make its way down. But it is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target.
That was Mary Daly of the San Francisco Fed speaking to Yahoo Finance. Mary Daly and other Fed officials insisting there's more work to do. Despite yesterday's subdued CPI print, President Biden taking a bit of a victory lap and crediting his Inflation Reduction Act, but regressing the name, saying the title doesn't draw enough attention to its impact on the overall economy. This coming ahead of the legislation's one-year anniversary next week. I want to touch base with Katie Lyons for a final word down in Washington, D.C. Kayleigh, isn't this exactly what the Republicans said a year ago, that it shouldn't be anything to do with inflation?
Well, that's exactly right, because not only is this about, yes, investing in clean energy and the transition, but there were also things related to healthcare and the tax code in this as well. And obviously, this wasn't the most bipartisan bill that has ever gotten through Congress, though the president did manage to get it through there. But it does speak to the fact, John, that he's having difficulty selling it because Americans' perceptions of inflation in the economy just don't necessarily track with progress being made, even though progress is made. That brings us back to what Federal Reserve officials have been saying, even in light of the data we got yesterday. Mary Daly saying there's still more work to do. Raphael Bostic's talking about they still need to get to that 2% goal. Michelle Bowman, of course, earlier this week saying they may need to hike rates further in order to really get price pressures under control. We'll, of course, get more clarity on the Fed's thinking in the minutes next week, but it really ultimately comes down to, for the president, John, what the American people are thinking. Polling consistently shows that there is high disapproval of his handling of the economy. His overall approval ratings remain low because at the end of the day, even if the price or the pace of inflation moving higher is going down, prices are still high for voters, and the president is dealing with that as best he can, but it's not necessarily working in his favor at this point.
Kayleigh, I've got 10 seconds. Why does Mike McKee get a day off for his birthday and you don't?
That is an excellent question, John. You should ask it to management.
Got to figure it out. Katie Lyons, happy birthday. It's good to see you. You enjoy the weekend. Thank you. About 23 minutes into the session, we're down here by 0.5%. Your trading diary up next.
maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The story of the session so far. Data out of China, not great. That's been the story of the week so far. PPI this morning, a mild upside surprise. Treasuries down, yields up, stocks lower. In the equity market right now, on the S&P, down by 0.4% and a touch more on the NASDAQ. That's the price action. Let's get to the trading diary. UMich Consumer Sentiment Survey, top of the hour. Don't miss that. Looking ahead to next week, U.S. retail sales coming on Tuesday, plus Fed speak from Kashkari and others. We'll get some Fed minutes on Wednesday, some earnings from Target and Walmart through the week, and finally, another round of jobless claims. That does it for the next week. That does it for me this week. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. Have a wonderful weekend and good luck for the rest of the trading day. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto. The people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture down.
The OK is getting ready to make a decision.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good morning, Matt Miller here in the Interactive Broker Studio with Simone Foxman.
Good morning.
Paul Sweeney is chilling out on the Jersey Shore this morning. Hopefully he's still asleep. I guess that's unlikely at 10 o'clock, but it depends.
10 a.m. You know what?
It depends what happened last night.
Summer Friday.
At the Sweeney compound. We got a lot of exciting guests on the show today. Jennifer Lee over at BMO is going to take us around the world to see which economies are where in terms of recession and inflation. There's still debate about what the inflation data is showing us. The supercore is accelerating, but Bob Teeter from Silvercrest will join us with his soft landing forecast. And can you imagine calling for an Uber and somebody shows up on a motorcycle?
That'd be cool.
Would you get on the back and
I
go?
would, yeah, why not? Especially in a place like Southeast Asia.
In the Philippines, there's a company called Angkas that has 4 million downloads, 30,000 biker partners. So we'll talk to the CEO of that company. But first, over to John Tucker with your Bloomberg Business Flash.
All right, Matt and Simone, let's get right to it. Top of the hour data dump, the University of Michigan. Now, I'm going to go right to the thing I always do, the inflation expectations. One-year inflation expectation coming in lower than expectations. The 10-year, 5 to 10-year inflation expectations from the University of Michigan sentiment survey, 2.9%. That is lower than expectations and lower than the previous month. So that tends to be a self-fulfilling prophecy. You expect lower inflation, you're not going to spend as much. Inflation does come down. Overall, the headline, the University of Michigan sentiments, 71.2. That is right on target for the month of August. Earlier, we had the inflation report. That was a little higher than expected. Producer prices for the picking up in July. And economist Andrew Hollenhorst isn't so sure we can avoid recession in the U.S.
Wage growth running around 5% by various different measures, that's not an economy that's going to bring inflation back down to 2%. So, yeah, we're getting a couple months of softer inflation readings here. That's certainly going to look like a soft landing. I don't think that's where we're headed.
And then right to oil, headwinds building as oil prices remain at elevated levels. Energy is the only major industry in the S&P 500 that was higher as yields are higher. Technology also especially vulnerable. You had Microsoft, NVIDIA, and Apple weighing on the indexes. S&P 500, 7 points lower. That's down 0.2%. The NASDAQ 100, 80 points lower. That is down 0.5%. And after we got that data from the University of Michigan, Dow right now is up 65 points, a rise of 0.2. Two-year yield, 2 basis points higher. That's at 487. We check the markets for you all day long. Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Simone and Matt. I hope that made sense.
Makes sense to me.
It did make sense. But also, I was waiting. While I was listening to you, I was thinking, I wonder if Alex is going to do any better here.
Oh,
we're going to bring in Alex Semenova
Tough act to follow.
from Bloomberg News. She's got your market drivers report. Alex, we're looking at stocks down. At least the S&P and the NASDAQ are down. The Dow Jones Industrial Averages rising somewhat. Bond yields rising because we got a hotter than estimated PPI report.
Yeah, so it's a down day in markets. I got to mention one company that I'm looking at, Virgin Galactic. It is paring its earlier gain, down more than 2% now, but it was up earlier in the day after the company said that it's going to launch its next Taurus space mission in early September, just a few weeks from now. It kicked off its commercial operations in June, flying out the Italian Air Force on a research mission, and this is a key step for the company, which has long been trying to commercialize space travel. Billionaire Richard Branson said that he wants to create a space line for Earth, and it's been a long time coming. The company was founded in 2004, originally promised to begin flying passengers as early as 2007. Tickets were $200,000. In 2014, they sent out a flight. It crashed, killing one of the pilots. They took a little break and kind of relaunched this in 2022. Now tickets are $450,000. $1,000, and it has an entire backlog of customers waiting. So its success is contingent upon how successful it'll be and actually sending out these flights. The stock is underperforming this year, just slightly, but it is well below its highs in 2021.
It's interesting too because I feel like we were up in the pre-market and now we're down 2.3%.
Seems like everything is taking a breather today. With this
Yeah, maybe it's broader market moves. I mean, maybe it's just ongoing question marks about Virgin Galactic's down 55% in the past year. So it's been a rough run. What else are you watching, Alex?
So from space travel to air taxis, another company this morning is Archer Aviation. It's another one that was up as much as 7% at the open and now also pairing that gain. I think shares were up about 1% the last time I looked at my terminal. It said that it raised $215 million in funding, bringing total funding to $1 billion as it works to win regulatory approval for commercial operations in 2025. It also settled some litigation with Boeing and will now work with the company on autonomous technology to kind of help launch its air taxi.
All right, so we're talking a lot about taxi service, right? To space, air taxis. We got
motorcycles later.
Motorcycle air taxis a little bit later. No, motorcycle taxis, not air taxis.
Motorcycle air taxis. We should suggest that.
I didn't see really a heck of a lot going on in the market this morning in terms of single stock names. GM and Ford have had a tough week, right? They're down about 5 or 6% as they get ready to kind of battle unions. What else is moving?
Yeah, I think an important name to talk about, of course it always is Apple. Shares are down again today. If it closes lower, it'll be 9 out of the 10 last trading sessions that the stock is down. I want to point out an interesting tweet from Bill Gross last night. He said, Apple, the market's bell cow, seems to be headed for the barn, and most of the herd follows, not the slaughterhouse, but the barn for a much needed rest. And that's kind of consistent with what some strategists have been telling me, is that after this incredible momentum that we've seen in big tech shares, we might see a little bit of breather in that section, but we are seeing signs of outperformance in other areas that have been laggards this year. People are kind of rotating into healthcare, industrials, areas that have, are backbones of the economy, as there is still some soft landing optimism intact. It's not necessarily a bad thing. It's not necessarily a sign that there's going to be a broader sell-off in tech shares, but there is a bit of a rotation. We've seen a lot of banks call this. Bank of America, Goldman Sachs all said that the equal weight S&P 500 is actually set to outperform the cap-weighted index in the second half of the year. So a little bit of a rotation happening that some folks say is pretty normal.
I guess if you look at where Apple's trading, I mean, flirting down 0.1%, and where the market's kind of going back and forth. I see it today. The enthusiasm for potentially.
Did you see the story on Amazon? They have $118 billion in cash, and they just don't really seem to know what to do with it.
Oof.
I saw that Apple has $167 billion, and then I quickly looked at Disney's market share at 165. So I feel like Apple could buy Disney and still have a couple billion to spare.
Yeah, I mean, this is a company that no matter what happens day to day is still healthy, still, one that everyone is pretty confident about. Strong balance sheet, consistent revenue.
It's funny you mentioned Amazon too, because it wasn't the whole point to cut back on some of those overt cost-cutting measures. Now it's left them with a pool of cash.
Yeah, so much money and not sure exactly what to do with it. Alex Semenova, thank you so much for joining us. Alex Semenova with the Market Drivers Report. I want to get to the bigger macro picture right now because economists